sites get tax refunds, which could provide them with much needed financial. Go to irs.gov/volunteers and fill out the sign up form. The IRS will put you in touch with VITA and TCE organizations in your community and answer any questions you may have about the volunteer process. To sign up and make a difference in your community, go to irs.gov/volunteers. with low to moderate income may be eligible for the income tax credit, also called EITC. You must meet requirements, but if you qualify, it can mean a bigger refund that you can get. It depends on your income and family size. Families with at least one qualifying child can get thousands of dollars of their tax refund. Even workers without a qualifying child may be eligible for the EITC. When claiming the credit on your tax return, the important thing is to get even basic errors. Can any child you claim meets all the qualifying rules. Using IRS free file software to file electronically is a great way to file an accurate return. Ask you questions and will file and process all the math for you. Or you can get free tax preparation help at a volunteer site near you. If you use a paid tax professional, someone you trust to file an accurate return, the IRS begins issuing any refund claiming the EITC or the adult child tax in February. Here are some links that can help you learn more. Go to irs.gov/EITC to see if you're eligible for the tax credit. irs.gov/free file has links to free file software options. irs.gov/VITA has locator tools where you can find a site near you or volunteer will prepare your taxes for free. Finally, you can get tips for choosing a tax preparer at irs.gov/choose-a-tax.
I was cleaning up my digital files one morning, getting everything in order for another tax season. She walked in. Why, Mrs. Davis, what an unexpected pleasure.
Sorry, not to call first, but you know there's a long game. I had a cancellation. No, to myself, Holly, the tax is done. So here I looked.
Just vibrant as ever? Are you still working over inheritance?
Oh no! See, I finally got custody of my 10-year-old Christina. So I opened up a little shop of my own house, so I'd be home when she gets home from school.
Excuse me, Miss Davis. I'm just opening up your records last year and open up a new file for this year.
Take time.
So, what's the name of your new business?
Air Heaven. How perfect for that?
We're doing business now. File Schedule C. How much did you make last year?
$12,000.
And did you bring records with you?
Records? I don't know what you mean.
Well, taxes and claim the EITC. You must show how much you make salon fees.
I have to count my tips. That's not income. Gratuity for good service and my personality.
It counts. There you go. I also need all of your allowable expenses for equipment, plus, etc. If you keep careful records, then you'll need to reconstruct them to the best ability. Otherwise, as an ethical preparer, I cannot do taxes.
Well, I am good at instruction. Tell me what to do. May I?
Sure. Shows what place you had each day?
Oh, yeah.
Good. Do you get customers and keep copies?
Well, no. I put down in my appointment book how much they pay.
Provide spray, shampoo, conditioner.
Oh, yes, it is a full service month.
Those are all allowable expenses. Do you have receipts for purchasing them?
Well, I didn't save down at the beauty supply store?
You just well, you need to get equipment too: hair dryers, combs, curling irons, etc.
I need a credit card for everything. Does that count as a record?
Yes. Please pull all your statements from last year. Now, tell me, you have any homes besides your salon?
No, I just use the kitchen for shampoo and color. And I style them up. Well, I have a couple. No, they come to me. They like the alien.
Davis, I cannot continue this discussion. If you don't...
Please continue.
When you come back, Mrs. Davis, you'll need to bring a complete record. Be sure to put all of your income, including tips. Bring all your credit card statements or complete record of her store.
This is going to take some time.
Yes, it's good you're starting early. Once you get this year squared away, I'll show you how to keep proper records from now on. Mrs. Davis?
Nice, it's me. I went through every page of my appointment and totaled all my fees and tips. Turns out I made a little less than I also calculated how much hair color and hair supplies I used based on the number of appointments and types of service I did.
Excellent.
Then I cross-referenced my credit card receipts supplies with the amount the supply store gave me just to make sure my estimates from them were accurate.
This looks very thorough. And nice summary sheets.
Why, thank you. So we'll get EITC, how much will it be?
Well, according to these figures, you made $10,500 in services and tips last year. Expenses of $19. That's the net income of $600. And yes, you do qualify for the EITC, although not as much as last year's.
I was hoping for more money.
This is what you rightfully should get. These actual records. Records you get back in case the IRS ever wants out of your return.
Yeah, organizing them is giving me ideas.
Welcome to Applying for Section 501 Status Overview course. This course is presented by the Exempt Organizations Office of IRS. Hi, I'm Legal, the Stay Exempt, and I'll guide you through the courses here at Stay Exempt. In this course, I'll talk about the life cycle of a typical tax-exempt organization, and you'll become familiar with the benefits and responsibilities associated with achieving exempt status. You'll learn the basics of 501c3 eligibility, the difference between a private foundation and a public charity, and how to apply for tax-exempt status. Finally, we'll talk about the rules for running an organization while under consideration for tax-exempt status. Let's start with basics.
Hi, I'm Richard. I've had a passion for helping animals since I was a child. I'm considering starting an animal rescue to fulfill my life's dream of preventing cruelty to animals. I've heard it could be advantageous to obtain 501c3 tax-exempt status, but I'm not sure what all that entails. Can you help me?
Well, it's a good thing you came to stay. Be happy to help you. help you through the process of understanding 501c3 tax status. By the end of this experience, what it takes to become an organization with 501c3 exempt status. Section 501c3 is one of several parts of the Internal Revenue Code providing tax-exempt status to qualified organizations. 501c3 includes both public charities and private foundations. We'll discuss the differences later, but in this course, we'll mostly be talking about public charities.
Wow, that's good to know. So, how do I do it?
Well, Richard, being a tax-exempt organization is not a static thing. It's a process with a whole life cycle to it. Let's talk about the life cycle. And once you understand the process, then we can talk about benefits and responsibilities. After that, I can walk you through the first steps of applying for tax-exempt status and point you to some great resources for operating as a tax-exempt organization.
You mentioned that there's a whole process to becoming recognized as exempt under Section 501c3. What's that like?
There are 5 stages in the life cycle of a public charity. They include starting out, applying for exemption, required filings, ongoing compliance, and significant events. The first 2 stages, starting out and applying for exemption, are unique because you should only do them once for any single organization. For the purpose of this course, we're only going to concentrate on creating and maintaining one organization at a time. What's different about the other 3 stages is that a single organization has to deal with each of those issues multiple times. Some require filings are annual, for example. We'll talk about these stages in a little more detail. Before we move on, it's important that you know a lot more information about the life cycle on irs.gov's Charities and Nonprofits webpage.
So, if I'm starting out, what's the first thing I should do?
First, you need to create an organization under your state's law. Your state will have rules that will likely make your animal rescue a nonprofit, which is a state-level classification. When you're creating your organization, you need to create based on the requirements of your state. You'll need these if you apply for 501c3 tax exemption. To apply for federal tax exemption, you'll need to acquire an employee identification number, or EIN, which is issued by the IRS.
But I don't have any employees, so I'm not an employer.
Even so, you still need an EIN. Your EIN is similar to your personal social security number. Only it's for your business. It identifies you to the IRS. If you decide on applying, you'll probably need more information on the EIN step. Next is applying for tax exemption.
So, you said the next stage was applying?
That's right. For this stage, you'll need to fill out Form 23. That's a big step. There are resources to help you on the IRS website. We'll be covering this step later in this training once you decide to apply for tax-exempt status.
That sounds great. What's next?
Now let's talk about your required filings.
So, you said that this stage is different because these are things I'll have to do regularly. What are the requirements?
Once the IRS has your organization tax-exempt status, it's important that you meet mandatory annual filing requirements. Most 501c3 organizations need to file annual exempt organization returns, and some organizations may be required to file related business income tax filings and other returns and reports you'll learn about here as exempt. Once you have your tax-exempt status, you should look into some of the other courses to stay exempt, like required disclosures, unrelated business income, and courses on the annual form you'll submit before 990. The next stage is ongoing compliance.
All right, so I know I have annual filing requirements. What's next?
Well, it's helpful if you understand how an organization can avoid jeopardizing its tax-exempt status. Employment taxes, public disclosure requirements, and other ongoing compliance issues are also important. There are other courses here at Stay Exempt that can help you with that. There's the Maintaining Tax-Exempt Status course, one on required disclosures, which tells you what information the public is entitled to see, and employment issues courses. You should go through those when you've applied for tax-exempt status. There's one last stage, the significant information.
So the last stage is significant events. What kinds of significant events are there?
These significant events all have to do with your tax-exempt status. The events include, but aren't limited to, audits, private letter rulings, and termination proceedings. For more information on this stage, go to the IRS website. Now that you've learned about the stages in the life cycle, let's try an exercise. Let's see how well you remember the life cycle. Great job! You've completed the life cycle section of this. Next, we'll talk more with Rich about why tax-exempt status might be right for him and what responsibilities he'll have if he's granted 501c3 exempt status for his organization.
Alright, so I'm just starting out. What steps should I take before applying?
Before you can be sure that 501c3 status is right for you, you'll need to understand some benefits and responsibilities that come with tax exemption, the steps required to become tax exempt, and the rules your organization must follow after you apply. As your animal rescue grows, your exempt status responsibilities will grow too. First things first, you'll need to learn about 501c3 status so you can make an informed decision and then apply. Next, we'll do an exercise together to separate the benefits from the responsibilities of 501c3 status. So why don't you try to guess what the benefits of 501c3 tax-exempt status are? Look through the list and select options that seem like benefits.
I see there are a lot of financial benefits.
That's right. In addition to being exempt from federal income tax, contributions to organizations exempt under Section 501c3 are tax deductible. You may be exempt from paying state income, sales, and employment taxes. You have access to reduced postal rates. You are exempt from paying federal unemployment tax, and you can receive tax exempt financing.
With all these great benefits, I bet there are responsibilities as well.
Of course, go over them.
So what are the responsibilities for a tax-exempt organization?
Your most important ongoing responsibility is to keep your organization's activities focused on accomplishing the exempt purpose you were approved for. You'll also need to make sure your organization's records are in good order, that it meets annual IRS filing requirements, and it complies with disclosure rules. I'll give you a brief overview of these last three.
Okay, legal. You mentioned record keeping. Do I have to keep a lot more records than I normally would?
You should keep detailed records, including records you probably want to keep for any business. For example, you're required to keep books and records detailing all activities, both financial and non-financial. Publication 4221-BC, Compliance Guide for 501c3 Public Charities, has information on why you need to keep records, what records you should keep, and how long to keep your records. Most public charities recognized as tax exempt under Section 501c3 of the Code are required to file an annual information return, either the Form 990, Form 990EZ, or the Form 990N. Good records make it easier to complete your required endings. Certain categories of organizations are not required to file, including churches and certain church-related organizations.
Who else do I have to show these records to? And do I have to make all of my records public?
You're required to make public certain documents that you file with the IRS. but not all of your records. The organization's annual return for its 3 most recent years after the due date, including any extensions. This includes Form 990, 990EZ, 990PF, and Form 990P. All Form 990 schedules, except Schedule B, their attachments and supporting documents. Your approved application for exemption and all supporting documents, and the determination letter from the IRS showing that your organization has been granted tax-exempt status. There are additional rules about what must be disclosed, how to provide documentation, and consequences for non-compliance. All of that's covered in the required disclosure course on Stay Exempt. Let's test your knowledge again. Which of the following is not a responsibility of a public charity? You've learned about benefits and responsibilities associated with 501c3 status. Next, we'll talk more with Richard about why this status might be right for him and what he'll need to do to apply for it. So Richard, now that you know basically what it means to have a 501c3 organization and how to maintain it, do you think you're ready to apply?
Yes, I can definitely see how this benefits my organization. What do I need?
Do you have the ITIN?
No, I don't. But I remember you saying I need it whether or not I have employees. How do I get one?
There are a number of ways you can apply for an EIN. Is to go to the IRS website or call our toll-free number and get an EIN you can use immediately. You can fax your Form SS4 application for employer identification number, and you'll receive your EIN within 4 business days. Or you can do it the old-fashioned way by completing Form SS4 and mailing it to the IRS. Next, you need to gather your organizing documents.
All right. I know how to get my EIN. What else do I need?
An organization can't qualify for exempt status without an organizing document. That means your application will be rejected without it. For corporation, which is an organization with corporate status by a state agency, its organizing document will be its articles of incorporation. For others or unincorporated organizations, the organizing document may be called a charter, constitution, or articles of association. To qualify for exemption under Section 501c3, the organizing document must contain 3 provisions, including some specific language. First, the organizing document must have a clause that limits the organization's purposes to one or more of the purposes listed in Code Section 501c3. Here's an example of the wording of this clause. Next, the organizing document must not give the organization the ability or permission to engage in activities that don't advance those exempt purposes. Finally, the organizing documents must include a dissolution clause, which states that the assets of the organization, such as the organization's money and property, are permanently dedicated to an exempt purpose described in Section 501. Here's an example of the wording of the dissolution clause. There's more information clauses in Publication 557. You can find more information, including sample documents, at the Charities and Nonprofits section of irs.gov.
I've heard an exempt organization should have bylaws. Bylaws different from the organizing documents?
Yes, Richard, bylaws are an organization's internal operating rules. Federal tax law doesn't require specific language in the bylaws. However, state law may require you to have bylaws, so it's a good idea to contact your state to find out the specific requirements.
My organization is California. Do you know who I should contact there?
In the Life Cycle Public Charity area of the IRS Charities and Nonprofits page about the bylaws, and you'll find links to the websites of the appropriate state officials. Let's test your knowledge. Which of the following are requirements for the organizational documents of charities applying for tax-exempt status? Great job. Now you understand the basics of 501c3 eligibility. Next, Richard learn how to determine if an organization is a private foundation or public charity.
You mentioned that an organization must have one or more specific purposes to qualify as tax exempt under Section 1C3. What are those purposes again?
A 501c3 organization is organized and operated exclusively for purposes that are religious, charitable, scientific, testing for public safety, literary, or educational, designed to foster national or international amateur sports competition, or for the prevention of cruelty to children or animals. There are many kinds of organizations that operate for these purposes. For example, organizations that provide relief of the poor, distressed, or underprivileged, those that legislate pensions, or those that defend human and civil rights usually qualify as charitable organizations. Educational organizations can be schools, museums, symphony orchestras, training for the unemployed, dance classes, and zoos. If your organization doesn't operate for one of these exempt purposes, perhaps it meets another 501c3 category, like 501c4 for civic leagues, 501c19 for veterans organizations, or even 501c7 for social. Download publication 557, tax exempt status for your organization.
So, because I'm planning to start an organization that prevents cruelty to animals, a list of 501c3 purposes you discovered, do I need to do anything else to establish that it will qualify as a 501c3?
Yes, you need to show how your organization will meet the organizational and operational test, but we'll focus specifically on how a prospective 501c3 organization. First, let's talk about the organizational test. This test is used to determine if the organization is properly organized. To pass this test, the organization must limit its purposes to one or more of the exempt purposes listed in Code Section 501c3, not permit the organization to engage in a non-exempt activity, and ensure that assets of the organization are permanently an exempt purpose.
This sounds really familiar.
That's because these are provisions you need to have in the organizing document we just talked about. So if you write your organizing document correctly, this test will be easy to pass. Now let's talk about the operational test.
Okay, so the organizational test was pretty easy. What about the operational test?
Well, the operational test covers how your organization is actually operated. To pass the operational test, your organization must show that its principal activities will be to further its exempt purposes. Your organization also has to limit the participation in certain types of activities and refrain from others. The IRS assesses the activities you describe in the Form 1023 application to make sure they qualify. This test is conducted when you're first applying for tax-exempt status, but if your activities get out of balance after you receive your status, or if your organization engages in prohibited activities once you're up and running, you could lose your tax-exempt status and be subject to both taxes and penalties.
What are the restricted and prohibited activities?
If you're interested in learning more about these kinds of activities, you should start with the Maintaining Tax-Exempt Status course, which discusses how you could possibly jeopardize your tax-exempt status. There's also the Unrelated Business Income course, the Political Campaigns and Public Charities course, the Required Disclosures course, and the Employment Issues course. Now let's talk about the differences between a public charity and a private foundation.
So one test can be recognized as a tax-exempt charity?
Not quite yet. When an entity qualifies as an organization, the IRS presumes it's a private foundation.
So what's the difference between a public charity and a private foundation?
The main difference is where the organization's financial support comes from. Generally, a public charity has a broad base of support, while a private foundation has very limited source support. There are also different tax rules. So, for example, private foundations are subject to excise taxes that aren't imposed on public charities. There are more differences, and you can look into those .gov website on the cycle of a public charity private foundation. There's also a course on foundation classification called Wonderful World of Foundation Classification. For now, we'll concentrate on public charities. Some organizations automatically qualify as public charities based on the code, so they're called statutory public charities. Some examples are churches, schools, and organizations providing or hospital care, including medical education and research. These organizations still have to pass the operational and organizational tests. Or if your organization seeks public support, or if it provides support to other public charities, you may qualify that way. Otherwise, you'll have to demonstrate that you are a public charity by other means.
My friend Chloe is starting an organization that could be considered a private foundation. How can she show the IRS that her organization is actually a public charity?
If Chloe's organization is not a statutory public charity, it may be a public charity if it passes the organization and operational tests and shows that it receives broad public support. To have broad public support, her organization must be able to demonstrate the following: that it receives a substantial part of support in form of contributions from publicly supported organizations, governmental units, and or the general public, or it normally receives no more than 1/3 of its support from gross investment income and unrelated business income combined, and gets more than 1/3 of its support from contributions, membership fees, and gross receipts from activities related to its exempt functions. This is another situation where good record keeping can really help you. Let's talk more about Chloe's situation.
Chloe's organization is still really small. I'm not sure if she can show broad public support yet.
No problem. She can show that her organization can reasonably expect to meet these criteria. Her organization, if granted 501c3 status, will be treated as a public charity for the first 5 years, regardless of how much public support it actually gets.
So what happens on year 6?
At that point, the IRS starts monitoring the status of all public charities based on public support reported on Schedule A, public charity status, and public support of your Form 990. Because her organization is not actually a public charity, she'll have to show that her organization is one of the public support tests over a 5-year computation period, including the current year and the 4 preceding years. If her organization passes one of the tests, her organization will remain a public charity for that year and the next tax year. So let the appropriate answer to go in the blank space. Enter the appropriate answer. Great job. Now you know how to determine whether your organization is a private foundation or a public charity. Next, we'll help Richard the basic requirements of applying for tax-exempt status.
Now that I understand the benefits of tax-exempt status under Section 501c3, I think I'm ready to start the application process.
Congratulations, Richard. Filling out the forms can be a big task. But before you start, there are a few things you should know. First, you need to know which documents are required, the timeline for applying, the user fees for applying, how group and church exemptions work, and key information for running your organization while waiting for tax-exempt status approval. First, start with the Form 1023, as that is the bulk of your application.
What do I need to apply for tax-exempt status?
You need 2 basic things: Form 1023 and your user fee.
What is Form 1023?
Form 1023 is the application for recognition of exemption document.
So how much is this going to cost me?
Well, the amount changed from year to year. The user fee is based on the organization's average annual gross receipts over a 4-year period. These are the emission receipts from all sources before taking out any costs or expenses.
But mission has been around for 4 years.
Gross receipts are based on funds your organization plans to receive or funds it actually received over a 4-year period.
Is there a deadline for me to file my Form 1023?
Good question, Richard. There are time limits. Generally, in order for the tax-exempt status of your organization to be recognized from the day you open, you 1023 within 27 months of the end of the first month was created. This timeline graph will show you an ideal schedule for a new tax-exempt organization.
So how long will it take to get my application approved?
The IRS receives many applications for exemption, ranging from very straightforward to extremely complex. Immediately after receiving your application and user fee, we'll send you an acknowledgement notice and deposit the user fee. If we're able to approve application, or if we need only a minor amount of additional information to complete our review, you'll hear from us again in about 90 days. If the application is very complicated or missing a substantial amount of information, it'll be assigned to an exempt organization's, also known specialist, directly with you to get all the information needed to proper assessment. So, if you haven't from us 90 days after you receive the acknowledgement notice, go to Where is my exempt application on Gov. If your organization meets the requirements for exemption, the IRS will issue a determination letter recognizing your organization's exempt status under Section 501c3, also showing your foundation classification. This determination letter is an important document. You should keep it with your organization's permanent records. You'll need it for any public disclosure requests.
Okay, so what are group exemptions?
Sometimes the IRS recognizes a group of organizations as tax-exempt if they're affiliated with a central organization. This avoids the need for each organization to apply individually. A group exemption letter has an individual exemption letter, but it applies to more than one organization.
So if I work together with a couple of other animal rescues, can we apply as a group? Share the same overall mission, but we have slightly different organizational goals. Some focus on rescuing, others want to build a location for animals that can return to the wild. Another organization is strictly set up to promote animal rights by lobbying Congress for stricter animal neglect and abuse laws.
Well, yes, you have to have one central organization that all the organizations are affiliated with.
Churches have to apply to?
Another churches, including synagogues, temples, and mosques, don't have to file for tax exemption. They're exempt from federal income tax, and the contributions they receive are deductible. But even though they aren't required to file an application, many do in order to receive a determination letter that proves their tax-exempt status and specifies that contributions to them are tax deductible.
So, once I'm running an organization and I've started the application process, is there anything else I need to do?
Yes, you can operate as a tax-exempt organization while you're awaiting approval, but donors won't have assurance that contributions to your organization are tax deductible until your application is approved. While you're waiting for approval, you can learn more about the responsibilities of a 501c3 organization. Do you remember what those are?
Yeah.
With maintain your status. Let's try a couple more knowledge checks. Let's test your knowledge. So how do you determine the user fee with applying for tax status? Let's try an activity. Here are the items from the application timeline. Put the items in the proper order. Great job. Now you can explain how to apply for tax-exempt status and discuss the rule for running a tax-exempt organization. I'm near the end of this course. I know I've shared a lot of exempt organization resources with you. I've put them together here, so feel free to read them. On behalf of everyone in the IRS Exempt Organizations Division, thank you for taking this course. Before you leave, please take a minute to send us your feedback. The information you provide will ensure that this and other courses stay exempt, provide a valuable learning experience for future participants, and if you send your feedback, you print out a certificate of completion as recommending this course.
Hello, and welcome to this webinar, Understanding the One Big Beautiful Bill, Individual Tax Provisions. I see it's top of the hour. Glad you joined us today. My name is Kenji Chavez, and I'm a Senior Stakeholder Liaison with the Internal Revenue Service, and I'll be your moderator for today's webinar, which is slated for approximately 120 minutes. Before we begin, if there's anyone in the audience that is with the media, email to the address on. Be sure to include your contact information, news publication you're with. Our media relation and stakeholder liaison staff will assist you and answer any questions you may have. As a reminder, this webinar will be recorded for future viewing. If you're joining, I want to quickly mention some virtual webinar housekeeping items. First, closed captioning is available for today's presentation and will be available throughout the webinar. You can download several by clicking on the Materials drop-down arrow on the left side of your screen, as shown on this slide. We've attached technical help documents along with the of today's PowerPoint and other resources. Third, if you have a topic-specific question, please submit it by clicking the Ask Question drop-down arrow to reveal the text box. Type your question in the text box and click Send. Please do not send any sensitive or taxpayer-specific information. During the presentation, we'll take a few breaks to check in and engage with you. At those times, the polling style feature will pop up on your screen with a question and multiple choice answers. Select the response you believe is correct by clicking on the radio button next to your selection and then click Submit. If you do not get the polling question, this may pop-up blocker on. So please take a moment to disable your pop-up blocker now so you can answer the questions. We've included several technical documents that describe how you can disable pop blockers based on the browser that you are using. We have documents for Chrome, Firefox, Microsoft Edge, and Safari for Mac users. You can access them by clicking on the Materials drop-down arrow on the left side of your screen. We're going to take some time and test the polling feature. Here's your opportunity to ensure it is not on, so you can receive the polling throughout today's presentation. Audience, this example polling question will count towards the polling questions requirements to earn CE credit. Do you know who your local stakeholder liaison is? A, yes. B, no. Or C, what is a stakeholder liaison? Take a moment and click the radio button that corresponds to your answer. Give a few more settings to make a selection. Okay, so we're going to stop the polling now, And let's take a and see how the majority of you responded. And I see the majority of you chose A, yes. So for those of you like B or C, I encourage you to visit the IRS.gov website and enter stakeholder liaison in the search bar. You should see a link for your stakeholder liaison local contacts. That should take you to our page and learn more about our role as collaborative outreach champions and how to reach your local stakeholder liaison. We hope you receive the polling question and were able to submit your answer. If not, now's the time to check your pop-up blocker to make sure you have turned it off. Now that we have concluded our administrative items, we can move along with our session. Today's webinar is titled Understanding the One Big Beautiful Bill Individual Tax Provisions. This webinar is scheduled for approximately 120 minutes, top of the hour. Now, let me introduce our presenter. Richard Furlong is a liaison in the Stakeholder Liaison Office of the Internal Revenue Service Communication and Liaison Division. Mr. Furlong represents IRS at both seminars and online webinars where he discusses IRS policies and procedures, tax law updates, tax special data security, and emerging areas of tax administration. He coordinates the Pennsylvania liaison meetings. PA practitioner organizations meet with IRS to discuss latest developments in IRS policies, procedures, and practices to solicit feedback from the practitioners. Additionally, he provides IRS updates on topics including latest tax law changes, tax professional data security, and IRS tax pro accounts. Mr. Furlong is a graduate of the University of Pennsylvania Wharton School with a Bachelor of Science degree in economics. And with that, I'm going to turn it over to Rich to begin the presentation. The floor is yours.
Thank you very much, Genji, and good day, everyone. So let me begin by first going over our objectives for today's webinar. We will identify the individual tax provisions that were enacted in the One Big Beautiful Bill Act. We will explain the statutory rules governing the no tax on tips provision. We'll then explain the statutory rules governing the no tax on overtime provision. Next, we'll discuss the eligibility requirements and limitations for the interest deduction. We will also discuss eligibility requirements and calculation rules for the new enhanced senior deduction. And then provide you with information on IRS resources and other guidance for the One Big Beautiful Bill Act that are available at irs.gov and which will help you support accurate tax preparation. Now let me move on to several disclaimers for today. So here are the disclaimers for today's webinar. Please note that this is a high-level overview of significant individual provisions of the One Big Beautiful Bill Act, sometimes referred to as OBBBA, is formerly known as Public Law 19-21. Our presentation today is based on the Act's statutory language, along with IRS and Treasury Department guidance issued as of the date of this presentation. And the Treasury Department and the Internal Revenue Service carefully consider our stakeholder feedback before issuing final guidance. So now let's move on to a discussion of the no tax on tips provision. This is Section 7201 of Public Law 19-21, the One Big Beautiful Bill Act. And under the legislation, an individual can deduct qualified tips the years from 2025. Qualified tips under the law are tips received in an occupation that is by the IRS as regularly customarily receiving tips before December 31st, 2024. The deduction is limited to $25,000 per year for qualified tips per tax return, regardless of whether the filing status is single or marriage filing joint. And the deduction for qualified tips begins to phase out when modified AGI, modified adjusted gross income, exceeds $150,000, or for couples filing jointly, $300,000 for joint filers. The qualified tips received by a self-employed person are deductible, but only if the business's gross receipts are rate of its deductions. In other words, it has a net profit before this deduction. Employers must report qualified tips on W-2, or employers must report tips that they acknowledge to their employer on the form 4137 that's filed with the tax return. And if the tips are paid to a non-employee, the service recipient must report them to the non-employee on the form 1099 NC, 1099 MIS, or 1099K. And keep in mind that any amounts that do not meet the rules for qualified tips do not qualify for this deduction. Also, the deduction is only allowed if the Social Security number of the tax received and claiming the deduction appears on the tax return. Now, moving on to the tax eligibility rules. An eligible individual with this deduction can claim the qualified tax deduction on their income tax return, irrespective of whether they take the standard deduction or they itemize. And a person is married under Internal Revenue Code Section 7703, then they can claim the deduction only, and I repeat only, if both spouses agree to file a joint return. In other words, anyone filing married and separate cannot claim this qualified tips deduction. Also keep in mind that deduction is not allowed unless the taxpayer includes a valid Social Security number on their tax return for that year. And again, that Social Security number must be issued before the tax return's due date, and it was very important, it must be valid employment. And if the taxpayer omits or enters an incorrect Social Security number on the tax return, the IRS will treat this as a mathematical or clerical error under Code Section 24.8.7. And what this does is it allows the IRS to automatically assess any additional tax owed without sending a formal deficiency, as would be otherwise part of Code Section 613.B. Now, let me move on to special rules for workers in certain industries. Several individuals who have what's referred to as a specified service trade or business, sometimes abbreviated as STD, or employees who work for an employer, where the employer is STD, these individuals are not eligible for the qualified tips deduction. And generally speaking, SSTD, a special service trade or business, is defined in Internal Revenue Code Section 199 Cap A. These are businesses where most of the value of the business comes from the skill or reputation of the owner or employees. However, there is a traditional belief that has been used by IRS to inform these tipped workers in SSTDs that we will not enforce the specified business restriction on 2025 tax returns. Now, let's look at income limitations for individuals. So the net income limitation of each separate trade or business in which the self-employed individual receives qualified tips. Qualified tips from a trade or business cannot be more than those income from that trade business in which the qualified tips are received, minus the total of all other deductions allocable to that trade or business. So in addition to ordinary necessary expenses for a self-employed individual, other allocable deductions have to be deducted from the gross income before calculating the no tax on tips deduction would include the deductible part of the self-employed tax, the deduction for contributions to self-employed SEP and simple plans or other qualified retirement plans, and also the self-employed health insurance deduction. but those allowable deductions to the business do not include the new deduction for qualified tips. We'll see later if the deduction is claimed. Now let me move on to more information on this limitation. Again, this is the limitation for self-employed individuals. After you determine the other deductions that apply to the business, which I just mentioned, in which you earn the qualified tips, then you reduce the net profit scheduled to Schedule C, line 31, Schedule C, which goes to the 1040, or if you're Schedule E filer, line 28, G, to 28, K, or as a farmer, Schedule F, line 34, reduce the net profit on any of those schedules by the amount of these applicable deductions. Don't reduce them below zero for purposes of calculation. And remember again that some entrepreneurs have more than one trade or business. So if you have more than one trade or business and you receive qualified tips in more than one trade or business, then you have to allocate the deductions in a reasonable manner. Now let me turn now to occupations that may qualify the tipped employee for this deduction. So you can see back on September 19th of last year, September 19th, 2025, the Treasury Department and the Internal Service issued news release IR 2025-92. That news release provided on occupations where workers were determined by Treasury to be customarily regularly receiving tips prior to the first year of this deduction, in other words, prior to 2025. The One Big Beautiful Bill Act lists 8 broad categories and approximately 68 occupations. So here you see a snapshot of the news release, at least about half of the news release, which contains on irs.gov, and links over to the proposed regs. Moving on to the next slide, the 8 categories of tipped occupations announced in this news release are listed here. And these are 8 categories of tipped occupations, and they're defined in depth in the proposed regulations that were announced on September 19, 2025. So collectively, these categories contain about 60 specific occupations that workers can customarily receive tips. And you don't have to go to the proposed regs to see this list of all of the occupations. You can go to Go and see a list of all of these occupations. And what you'll notice when you look at the full list on irs.gov, you will see a reference to what is referred to as the Treasury Tipped Occupation Code, TTOC, which is a 3-digit code and provides descriptions of the occupations within the proposed list. And I'll come back to the TTOC later on. So now moving on next to a closer look at the all-important definition of qualified tips that were outlined in that news release on September 19th of 2025. In order to claim this deduction, the worker must both be an occupation on the list, which I just on the prior slide, and also receive qualified tips. Proposed regulations issued September provide a definition of what are qualified tips and what not qualified tips. And they include these factors. Qualified tips must be paid in cash or an equivalent medium. And that could be a check, could be a credit card, it could be a debit card, it could be a gift card, it could be a tangible or intangible token, readily exchangeable for a fixed non-cash, for example, a casino check for the dealer, or any other form of electronic settlement or mobile payment app should be denominated in cash. Moving on to some other requirements, qualified tips must be received from customers or, in the case of employees, a mandatory or voluntary tip sharing arrangement, such as tip pool, and we can often see those in restaurants. The next point is extremely important. Qualified tips must be paid voluntarily by the customer and not negotiation between and the service provider. Qualified tips do not include some service charges. For an example, as you see, some establishments, some restaurants impose an automatic 18% service charge for large parties and will distribute that amount to the waiters, the bussers, the kitchen staff. If that service charge is added with no option for the customer to disregard or modify it, distributed from it are not qualified tips. We'll have an example later. And finally, any amount for certain legal activities, including prostitution services or pornographic activity, are not a qualified tip under the One Big Beautiful Bill Act. So I think this is a good point to pause and tee up our first polling question for the SMBs.
Good idea, Rich. Audience, so here is our first polling question. The new qualified deduction is available for A, 2024, B, 2025 through 2028, unless Congress extends it, 2025 through 2030, or D, all future tax years. Take a moment and go by that complete statement. If you do not receive the polling question, please enter only the letters A, B, C, or D for response with your response in the Ask Question text box. Your response is timestamped. Audience, please remember that you need to answer at least 4 questions and participate in the live broadcast from the official start time for us 100 minutes to earn 2 IRS CE credits. The polling question that we did at the beginning of this presentation will count towards the requirement. I'll go ahead and give you a few more seconds to make selection and or submit your answers in the Ask Question feature. Okay, so we're going to stop the poll now, and let's share the correct answer on the next slide. And the correct answer is D, 2025 through 2028, unless Congress extends it. So let's know what you all did with this question. And it looks like 93% of you responded correctly. That's a great correct response rate. Great. I'll go ahead and turn it back over to you.
Well, thank you, Benji. That's gratifying. I haven't put anyone to sleep yet. So now let's turn to reporting. The first thing in mind is that for 2025, the Form W will remain the same as in prior years. Employers will continue to use the current W-2. In other words, there are no new boxes or codes for reporting tax-free tips or, as we'll see later, tax-free overtime. Box 12 and 14 already exist, and some employers report certain information there, but there are no changes to the 2025 W-2. And IRS has provided transition relief for 2025, as discussed on our next slide. So, and remember, the One Big Beautiful Bill was passed, signed on July 4th of 2025, right about mid-year. So, very quickly after passage, Treasury and IRS both made a decision not to change withholding tables, and then we provided transition relief that I'm discussing now that will not impose penalties for 2025 for good faith efforts in employers separately capture tax-free tips. Overtime on the W-2. As we'll see later, that's going to change for 2026. But remember, this is very important for employees who are tip employees, some of them may be your clients if you're tax professional attending. To be eligible for the deductions, the tips must be included as part of the total amount of wages reported on 2025 Form W-2, even though they may not be separately accounted for on 2025 W-2. Now, the employees can use Box 7 as in the Social Security tips on W-2, or if the amount that they report to their employer. Some employees use IRS Form 47 or equivalent to report their tips to the employer so that the employer can take into account that income for Social Security purposes, Social Security and Medicare withholding. Now, employees who don't report the tips to their employer, you'll see them in box 7 of the W-2. These employees, when they file their 2025 tax return, they may report unreported tips on IRS Form 4137, and that's not a new form. That's been around for quite a long time. Employers also use box 14 if they choose to provide tips or other information to the employees. Independent contractors for 2025. Now, remember what I said earlier. To be eligible for this new deduction for qualified tips, the tips must be included as part of the total amount of income received by independent contractors or self-employed individuals on the 2025 Form 1099 series, even if they're not separately accounted on the 2025 version of the form. So now independent contractors, they could use an earnings statement or other documentation such as receipts, point of sales system reports, perhaps they keep the tip log, perhaps they are in what we call gig economy, a 1099A from third-party settlement organization who pay, or some other documentary evidence that corroborates the calculation of the total amount of tips that are qualified tips for 2025. But remember, it must have a 1099, and that the amount of the qualified for the tips must be included in gross income on that 1099. And they would also consult with the payer regarding the available information that may assist in determining and documenting the amount of qualified tips. Now, both for employees and independent contractors paying this deduction, they are still responsible for that occupation in the list in the 8 categories we referenced earlier of tip occupations that were announced last year. And it's noted on this slide for 2025 tax year only, for purposes of this qualified deduction, the IRS will consider all employees to have not worked a specified service, trade, or business E and SSTB for only the 2020 tax year. So we're not enforcing that provision in the 2025 tax years. It references SSTBs. Now, in 2026, employers will want to maintain records for both tips and we'll see later for qualified overtime because they will be required to be reported on the 2026 version of the W-2. Now, moving on to the 2026 W-2, the 2026 W-2 and instructions are available on IRS.gov. As you can see on this slide, on the 2026 W-2, that we anticipate that there will be a new code TP to report tips, cash tips in box, and then that Treasury tips occupation code, that 3-digit code, referred to the acronym TTOC, the qualified professions that we've identified, that will be reported in a new box 14B. So that will be the 2026 W-2 statement. Now, let me move on to there are several examples that may help you better understand the new qualified tip deduction. So we first want to tee up example number 1 and read this to you as you're thinking about it. You work in a wait stand in a restaurant. You serve a group of 6 people. The restaurant has an automatic 18% charge that's added to the bill of any party of 6 or more people. That bill includes the 18% automatically on the tip line, and the bill includes that automatic gratuity part of the total bill presented to that group of 6. Even though the restaurant may distribute that amount you, the server, and your busters did not determine the amount of the additional charge and was not given an express option to ignore or change the amount. In other words, they did not give that voluntarily to the server. That 80% is not a qualified tip and not be deducted by server. And moving to example number 2, which is a variation on this, a little bit different. Again, we have a waiter on a wait staff in a restaurant. You give the customer the bill. You may be giving them a paper bill. You may, we see increasingly these days, giving the customer an electronic handheld point of sale device. And in this restaurant, because the charges for meals and sales tax, besides the charges for the meal for the party for 6, and the point of sale device also prompts the customer to leave the tip. So the customer has the option to voluntarily choose 15%, 18%, 20%, or no tip. The customer selects 18% voluntarily, pays the total amount with their credit card, because the customer has the right to the amount, including the option to leave no tip. In other words, everything voluntary. That 18% is a qualified tip under OBBA. Now, our next example covers yet another restaurant tip employee. Now, here there's some information to that server. They have only one employer. The employer in box 7, Social Security tips, included an amount of $18,000. No reported tips that the employee received did not report the employer. No unreported tips. So that restaurant server $18,000 in box 7 to figure the deduction for qualified tips, and they'll enter it $18,000 on new schedule 1A, which we'll look at later, lines 4A and 4C of that new schedule 1A. Now let's move on to example 4, which covers a hypothetical bartender, tip bartender. So this bartender is one employer only. Bartender is doing very well. They have $200,000 wages in box 1, and $15,000 reported in box 7. So, but for the year, that bartender reported to the owner, employer, $20,000 of tips on that IRS form 370. And then in addition to that, when they filed their 2005 and 40, they report unreported tips on that form 4137, line 4. So how does the bartender take all of this for purposes of the qualified tip deduction? The bartender sees the $4,000 reported on form 4137 plus either $15 from box 7 of the form W2 or $20,000 of tips reported during your to the employer on that form 470 to use to figure the deduction for qualified tips on Schedule 1A. Now let's pivot to another industry, a ride-sharing driver. Very common these days. A ride-share driver, they receive a 1099K from that third-party selling organization. That's the ride-share company. And that 1099K, and this is extremely important in this example, that includes tips in the overall total amount of compensation, income, and payments received by that rideshare driver. The rideshare company reports separately in the earnings statement on their rideshare app, let's say, or on their website, the fare earned by the rideshare driver and the tips received by the driver during the year. So in order to figure the amount of qualified tips for 2025, the rideshare driver uses the amount of designated tips by the rideshare company in their earnings statement or on the rideshare app on the website, even though it's not on the 1099K itself. Now let's move on to example number 6. And here we have a self-employed individual who runs a business tutoring for a local school. Tutors an independent contractor. Operated as a sole proprietor Schedule C, during 2025, the tutor received $500 in qualified tips from students that were reported to the tutor by the schools on Form 1099 NEC, and also reported separately in an earning statement provided by the school for which the tutor was working. So the gross income for the business wasn't a big business, $5,000 gross receipts, deductible ordinary necessary business expenses of $500, and that includes applicable deduction Schedule C, a self-employment tax schedule on, calculated on Schedule 1, line 15. So basically, the net income from the tutoring business was $4,500, $5,000 gross receipts minus $500 applicable expenses. But then moving on to the tip calculation, on that Schedule 1A, line 5, enter $500. And this tutor can take the full amount of the qualified tips from the business into account when figuring the qualified tip deduction. Why? Because the net income from that business work is the amount of qualified tips from the business. Remember, the net income is $4,500. So they can do the full $500, but those $500 were reported separately to report the 1099 NEC. So let me pause here, Kenny, and I think it's time for our next question.
Oh, yes. So here we go. Polling question 2. Like the answer that best completes the statement. The deduction for qualified tips, A, requires taxpayer to itemize deductions on Schedule A. B, is allowed for taxpayers using the married separate filing base. C, eliminates the refund to report tip income. Or D, none of the above. Same as before, please click the radio button that best suits the question. If you do not receive the following question, please enter only the letters A, B, C, or D that corresponds with your response in the Ask Question text box. Your response is timestamped. I'll give you a few more seconds to make your selection and or submit your answer in the Ask Question feature. Okay, so we're going to stop the poll now, and let's share the correct answer on the next slide. And the correct answer is D, none of the above. Let's take a look and see how you all did with this question. And 87% of you responded correctly. Excellent job. It looks like you're still paying attention, so I'll go ahead and back over to you to continue.
Well, thank you, Kenji. That's very fine. So now let's get to the next new deduction, referred to as the no tax on overtime, which was enacted in the OBBBA under Section 7202. And for years 2025 through 2028, an individual can claim an income tax deduction for qualified overtime pay received in those years, and years under current law in 2025 and 2028. Now, this deduction is limited to $12,500 per year for single filers and $25,000 per year for joint filers. There is a phase out. It begins to fit out when modified adjusted gross income exceeds $150,000 for single filers or $300,000 for joint filers. Now, what is qualified pay? Qualified pay is overtime earned under the Fair Labor Act of 1938. It's abbreviated FLSA. And that qualified overtime under FLSA exceeds the individual regularly to pay required as under the FLSA. And this is very important to keep in mind. Deductible amount of the no tax on overtime is only the half portion of time and a half. So we're referring to here is labor law, Fair Labor Standards Act, which for those covered under FLSA mandate 9.5 be paid for overtime hours. Now, just as we saw previously with the no tax on tips, qualified overtime pay must appear on the employee's form W-2 or the non-employee's form 1099 NEC. But as we saw earlier, transition rules apply for tax year 2025, just as they were reported to tip reporting. So to clarify, qualified overtime compensation must be included in X1, either the form W-2 or 1099 NEC, or possibly the 1099 MIS or 1099K. But this transition rule for 2025 to the separate reporting accounting requirement for qualified tips and overtime. And for more detailed information, I would refer you to IRS Notice 2025-62, which can get through the resources on one people bill at IRS.gov. Now let me move on to some other requirements for this tip. For this deduction for the no tax overtime. First, the deduction is available for itemizers and non-itemizing taxpayers. So it's not a delayed deduction. You don't have to itemize. But the taxpayer must have a valid or social security number on the tax return. And as with the case of the prior deduction, taxpayers filing married filing separate are not eligible to claim the deduction for qualified overtime. Now, in terms of reporting, employers and other payers required to file, information returns with the IRS, or in the case of W-2s, they file them with Social Security Administration, and then furnishes to their taxpayers, the employees or the contractors in the case of 299 series, showing the total amount of qualified overtime compensation paid during the year. Now, let me turn to a chart on our next slide showing the difference between 2025 and 2026 reporting. And this is a point we come back to on a couple of occasions today. So here we have a comparison chart, break down the reporting requirements for no tax on overtime provisions and no tax on tips for 2025 and then next year for 2026. Remember what I said earlier on 2026, there will be new, that form will be bought to W-2. There will be new box 12 reporting for tips and for and you can access the 2026 W-2 and instructions on irs.gov. And just before we get to our next one, remember, as you see under the IRS approach side of this grid, transitionally means that no penalties for employers and payers who do not separately report on the 2025 forms qualified overtime or on either the qualified overtime on either the W-2 or the 1099. And I encourage we have time to take a look at this 2025-62. And it's very understandable and provides great guidance in this area. So, can you pause where there's less water and turn it over to you? Share a polling question.
So we are at the half point with our polling questions. So here's our polling question, which states the qualified overtime deduction is allowed for A, overtime paid for hours worked over an hour a day. B, may be claimed by taxpayers filing the married filing separate. C, must be overtime covered under the Fair Labor Standards Act. Or D, is claimed on Schedule A itemized deductions. Again, your response is timestamped, so take a moment and click the radio button that best answers the question. If you've not received the polling question, please enter only letters A, B, C, or D that corresponds with your response in the Ask Question text box. I'll give you a few more seconds to make your selection and/or submit your answer in the Ask Question feature. Okay, so we're going to stop the polling now and show the correct answer on the next slide. And the correct answer is must be overtime pay required under the Fair Labor Standards Act. So let's take a look and see how you all did on this question. And it's 80% of you responded correctly. Rich, it seems the audience is this. I'll go ahead and turn it back over to you.
Well, that's great, Kenji. And now maybe to help reinforce the requirements for the qualified overtime deduction, I'm going to tee up 4 examples. And these are important. So no multitasking here. Pay attention to these. So the first example is a Fair Standards Act, or LSA, eligible employee. In 2025, this employee received $50,000 in regular pay and $15,000 for overtime hours worked. Box 1 of the W-2 for 2025 does not separately show the qualified overtime compensation, but this employee has access to the employer's payroll system, or the employer provides access, which shows that they were paid a total of $15,000 for overtime hours worked in 2025. So what's in that $15,000 of overtime? It's because they're only going to be able to deduct on Schedule 1A, or to include the qualified overtime. And qualified overtime is $5,000 out of the total $15,000 paid. So how did we come up with that? Well, the $5,000 is that quote-unquote half portion. Remember, for the purpose of this deduction, we're looking at the half of time and a half. So the total of time was $15,000. That would have been their base pay for hours worked, which was $10,000, and so $10,000 plus $5,000 brings it up to $15,000. Or conversely, this example is from the instructions, or also from the notice, the deduction would only be $5,000. So it's important to get the numbers right when you're calculating the amount of the qualified on Schedule 1A. So now let's turn to example number 2. Now this is the more generous employer, at least in terms of the amount they're paying for overtime. Here again, we have an FLSA eligible employee who works for an employer, but this employer pays overtime equal to twice the employee's regular pay. So in 2025, that employee received $50,000 for non-overtime hours and $20,000 for overtime hours worked. But the W-2 does not separately show qualified overtime compensation. However, this employee had a pay stub that showed $10,000 of the overtime pay was for the regular rate of pay for those overtime hours, and then $10,000, which is the double of the overtime pay, was the premium amount under the relationship that employee has with the employer. That's how they got $20,000 for the overtime, double the basic $10,000. But under LSA, it's only required. It would only be required to take $15,000, $10,000 regular wages for the overtime hours multiplied by 1.5. That would be $15,000. So this is $20,000, but this employee's $5,000, the quote-unquote half of the regular rate of pay for the overtime hours, regular the deduction for qualified overtime compensation. So you want to be very careful when you look at those statements in the payroll department or the pay stub, and make sure you're only using the half for qualified overtime for the calculation. Now let's move on to example number 3. here the pay stub, the fact pattern here is the same as the one we just addressed, but here the pay stub of that employee does not show the premium amount of overtime. In other words, the $20,000 is the total amount for the overtime hours. That would be the base plus the additional overtime rate as determined by that employer. So that $20,000 is double the regular wages for the overtime hours worked by that employee during the year. So the regular wages would be $10,000, which is 20,000 divided by 2. 9.5 would only equal $50,000. So $10,000 of regular wages times 1.5. So here, the half $5,000 is the amount required by LSA, even though the employer paid double that overtime. So they'll only use the $5,000 when figuring deduction for qualified overtime wages. And remember, when we're talking about overtime here at LSA, we're generally speaking about overtime hours worked beyond 40 hours in a work week. That's under FLSA. And then one example in a different industry, in law enforcement. So example number 4, we have a works in law enforcement, and the employer has a special overtime rule, which is addressed in Section 7 of the Fair Labor Standards Act. So that in 2025, law enforcement personnel was paid $15,000 for overtime hours worked based on work period. But for law enforcement under FLSA, they calculate the overtime based on a work period basis of 14 days, essentially the equivalent of 2 weeks. So that law enforcement personnel can include $5,000 of the overtime pay, which would be the half, and figure the deduction for qualified overtime compensation. In other words, the total amount of $15,000 divided by 5,000. And again, this example is essentially from the instructions to the 1A. And I highly encourage everyone, if you haven't already, to download the Schedule 1A instructions and to review these examples because they're great. So let's now take a pause after we've done the examples and see our next phone question.
Okay, audience, for the 4th question, select response that answers, why is tax year 2020 a transition year for the new qualified tips and qualified deductions? Is it A, taxpayers may choose which rules to follow, B, payroll systems and employers are adhering to new rules, C, the deductions only apply in 2025, or D, reporting is optional in 2025. Click radio button that best answers the question, or please enter only letters A, B, or D that corresponds with the response to the asked question text box. If you do not receive the polling question, your response is time-stamped. In the Ask Question feature. Okay, so we're going to stop the now, and let's check the correct answer on the next slide. And the correct answer is B. Payroll systems and employers are adjusting new rules. And it looks like 89% of you responded with. That's impressive response rate. Rich, I can continue.
Well, thank you, Kenzie. 2025 is a transition rule because Treasury and IRS indicators so such begin important payroll systems time to test their systems for something they have not previously been required to do. So now let's turn to the third deduction, referred to as the no tax on car loan interest, which is Section 7203 of the legislation. Now, this is a temporary provision for tax year after 2024 and before 2029, in other words, 2025 to 2028, an individual deduction of up to $10,000 for interest paid or accrued on a loan taken out beginning 2025 or later to buy a qualified passenger vehicle primarily for personal use. Now, this deduction is also subject to a phase-out. It begins phase out taxpayers' modified adjusted gross income exceeds $100,000 for single filers or $200,000 joint filers. Qualified passenger vehicle for purposes of this deduction will include a car, a minivan, a van, perhaps an SUV, a pickup truck, or even a motorcycle, but each of them cannot be used vehicles. They have to have final assembly in the United States, and the deduction, as was the case for the prior two deductions, is available both for itemizers and non-itemizers. So now let's look at the requirement for qualified inside. Qualified passenger loan interest means the interest paid or accrued during the tax year on loan taken out after December 31st, 2024 to buy qualified passenger vehicle for personal use. Now, the loan itself must be secured by a first lien on the vehicle, and that is described in Internal Revenue Code 163, paren H, paren 4, paren D, paren I, and that was amended by the One Big Beautiful Bill Act. Now, for this rule, the qualified debt could conceivably include any refinance loan, but only up to the amount of the original loan. And also, it does not include loan owed a related person under Internal Revenue Code Section 267B, 770, paren 1, or Internal Revenue Code Section 163H. Also, the type of qualified interest for this deduction does not, I repeat, does not include any interest paid or incurred on loans to finance fleet sales, on a loan for the purchase of commercial vehicle that is not used for personal purposes. Qualified interest would not include any lease financing, nor would it include a loan to buy a vehicle with salvage vehicle, or a loan to buy a vehicle intended solely for scrap or parts. Now, let's look at the very important definition of qualified vehicle, and this is extremely important for those seeking to claim this new edition. A qualified vehicle includes a car, minivan, van, SUV, pickup truck, or motorcycle that I mentioned a moment ago, has to have a weight rating of less than 14,000 pounds. And very importantly, has to have undergone final assembly in the United States. So, in other words, a portable vehicle would include any vehicle, again, final assembly of which the original use of that vehicle commences with the taxpayer, i.e. the new vehicle that for anyone. It is manufactured primarily for streets, highways, not including a vehicle operated exclusively on the rail or rails, at least two wheels. Again, could be a car, a van, an SUV, a pickup truck, or motorcycle. Has to be treated as a vehicle for purposes of Title II of the Clean Air Act, and has to have a gross vehicle weight rating of less than 14,000 pounds. I just meant that. That are not qualified, once again, include used vehicles, imported passenger vehicles. So how are you going to determine if the vehicle has final assembly in the United States? Well, as you can see in the slide, you want to check the VIN, the vehicle identification number, and that's the information attached to the vehicle on the dealer's premises. And remember that each for this new deduction qualifies only if the taxpayer lists the VIN, the vehicle identification number, on the new Schedule A of the return for the year. And we'll give you a snapshot later of the Schedule 1A. Now, additionally, let's turn now to what's considered personal use of the vehicle to qualify for the new interest deduction. This is a drawing from slide, again, and has an example, so I'm going to go fairly slowly through this. You consider to be purchased a qualified vehicle for personal use if, at the time you're alone to purchase that vehicle, you expect or anticipate that the vehicle for personal use more than 50% of the time that you or any combination of individuals who have a certain relationship to you. So it could be your spouse, you or your spouse's children, your grandchild, your father, your mother, brother, or sister. You also include an individual who has a main home for you, a member of a household. But collectively, 50% or more of the time expected to be used by that individual manufactured Miata, so within, that would be for personal use. So you can see an example here. By purchase of a vehicle that you expect to use to earn income as a driver for share service, but only about 50% of the time you expect to own that vehicle. So you expect to use the vehicle for personal use for the remaining 85% of the time. You're considered to have purchased that vehicle for personal use, more than 50%. So let me turn now to the lender reporting requirements. Now, under statute, there are required lenders or other recipients of qualified interest being paid will ultimately have to file for major returns with the Internal Revenue Service and then furnish statements to taxpayers showing the total amount of interest paid the lender or the other the interest received during the year. What I've seen previously, for purposes also of this deduction, 2025 is a transition year, so those new revenue requirements will not apply until the earliest of 2026. So, Kenji, I think it's time to call for another polling question for our audience today.
Agree. Audience, here is your fifth opportunity for earning C credit. Which of these statements is false for the no tax on car loan interest deduction? Is it A, this deduction is available for tax years 2025 through 2028? B, available to taxpayers that take the standard deduction, as well as C, interest on loans to finance vehicles are eligible, or D, final assembly of the qualified vehicle must be in the United States. Only to select your answer to the question, or if the question did not pop up, please enter only letters A, B, C, or D. Correspond with your response in the Ask Question text box. Responses are time-stamped. I'll give you a few more seconds to make your question, and or submit your answer in the Ask Question feature. Okay, so we're going to stop the polling now, and we'll share the correct answer on the next slide. And the answer is C. Interest on loans to finance used vehicles are eligible for the deduction is a false statement. And looks like 85% responded correctly. Audience, another impressive response. Rich, we're ready whenever you are.
Well, thank you, Kenji. So now let me review deductions under the One Bill Act, and this is the Enhanced Deduction for Seniors, Section 103 of the legislation. For tax years beginning after December 31st, 2024, and before January 1st, 2029, in other words, between 2025 and 2028, a qualified individual can claim an additional $6,000 deduction on their tax return under Section 151, C. and that was added by the One Big Beautiful Bill Act. So who is a qualified individual? Qualified individual is any taxpayer who is age 65 or older by the end of the tax year. And for a joint return, for both spouses to qualify, they would only qualify both of them for the additional $6,000 maximum deduction if each is 60 or older. Now, once again, there's a fade out, as was the case of prior deductions. This senior deduction begins to fade out, and the taxpayers modified the gross income for AGI exceeds $75,000 for single filers or $150,000 for joint filers. So you see that the fade out begins at a lower threshold than for the other deductions. And the deduction, once you get into the fade out range, is reduced by 6% of the amount the taxpayers modified its gross income exceeds the income limit. And by mentioning MAGI, modified adjusted gross income, let me define it. That basically means adjusted gross income plus any amounts that are excluded from gross income if taxpayer income allowed for foreign income exclusion under Code Section 911, or for income excluded bona fide residents of American Samoa, Code Section 931, or possibly excluded residents of Puerto Rico under Code Section 933. But for most people, without those excludable income categories, it would be AGI, would be same as modified adjusted gross income. Again, very important, a taxpayer cannot claim senior deduction on the security number of each qualified individual on the tax return. Now, moving on to some additional requirements for this new deduction. As was the case with the prior three deductions, is available for itemizers and non-itemizers. Once again, married filing separate cannot are not eligible for the deduction. For couples who are considered married, they must file jointly to be potentially allowed this deduction. What is the Social Security number? Well, the Social Security number must be issued in the United States, belong to a U.S. citizen or a person authorized to work in the United States, and that Social Security number must be issued before the tax due date. If the taxpayer omits or provides an incorrect Social Security number, the IRS will treat this as a mathematical or clerical error under Internal Revenue Code Internal Revenue Code Section C213 B. And what that would mean is that if it was incorrect SSN, it allows the IRS to assess any additional tax due without issuing a deficiency notice. Now, as I mentioned previously, we have a new Schedule 1A to claim for deductions that we just discussed. And let's look at the schedule in the next slide. If you spend some time with this, it's not that difficult in your schedule. So the first slide here has the front page of Schedule 1A. It's a two-part form, two-page form, I should say. The screenshot has page 1. Schedule 1A itself is entitled additional deductions, meaning the 4 deductions we discussed. Broken into 6 parts. So on this slide, part 1 in small font at the top there. That's where you calculate the MGI. Part 2 is where you calculate the no tax deduction. Part 3 is where you calculate the no tax and overtime. And then moving on to part 2, page 2 of the new Schedule A. Here on part 4, Roman numerals, calculation of tax and car loan interest. And here is one important VIN, vehicle identification number, if you're seeking to claim the introduction for a new car manufactured in the U.S. Part 5 is calculates enhanced deduction procedures. And then at the bottom of page 2, part 6, Roman 6, and this is where the deductions are all total and carried over to the 1040. So let me, on the next slide, tee up the 1040 itself. Now that we're in tax season, I'm sure many among our large audience today are very familiar with the 2025 1040. So here you see page 1 of the 1040 for 2025. But then I want to go to page 2. And this is where we've incorporated a new line, 13B, on page 2 of 2025. And where the total amount from Schedule 1A will roll into page 2, as you see here, 13B. And this is the blue box, or the box in the upper right-hand corner suggests, this is what we refer to as below the line, meaning below the line for adjusted gross income. So now I'm going to pause. I think we're ready for our final polling question.
Thanks, Rich. That is correct. This is our final polling question. So audience, Rich just spoke about this. So this is the polling question, so hopefully it agrees. For the new enhanced deduction for seniors, which statement is accurate? Is it A, changes the taxability of Social Security benefits? B, requires that individuals 65 or older claim Social Security benefits? C, requires that both spouses be 65 or older to claim this deduction? Or is it D, is subject to a phased-out limitation based on the modified adjusted gross income or the MAGI? If the pop up to you, click the radio button that best answers the question, or simply answer only letters A, B, C, or D in the Ask Question text box. Remember, responses are time stamped. I'll go ahead and give you a few more seconds to make your selection and or submit your answer in the Ask Question feature. Okay, so we're going to stop the polling now, and let's check the correct answer on the next slide. And the correct answer is B. The new enhanced deduction for seniors is subject to a phased-out limitation based on the modified adjusted gross income, or MGI. And it looks like 91% of you responded correctly. Job well done. Rich, I'll go ahead and hand it back to you.
Well, that's particularly gratifying, Kennedy, because it appears everyone knows that this new deduction, new enhanced deduction for seniors, does not have any relevance to the taxability of Social Security benefits, nor is it dependent upon whether the individual 65 or older who meets the other requirements to claim Social Security. So that's very gratifying. And audience, before I get into the other, I encourage you to stay with us. We're very fortunate later on to have 4 of the most qualified individuals in the Internal Revenue Service who've been working these 4 deductions to handle many of the questions that are coming in from today's attendees. So stay with us. So now I'm going to pivot to a number of other individual provisions that were impacted by the One Beautiful Bill. The first one is that the tax rates, which came into being with the passage of 2007 legislation that was known as the Tax and Jobs Act, or as you see here, TDA, those tax brackets, they were due to expire at the end of 2025, but One Beautiful Bill Act made those, kept those brackets now going forward permanent. So that's good news for most taxpayers. Also, beginning 2025, the standard deduction, for those who take the standard deduction, that will permanently increase, as you see on slide, to $15,750 for individuals, $23,025 for head of household, and $30,500 for married joint. And that will be indexed for inflation appropriately in coming years. Also, there are no more personal exemptions. $1,050 personal and dependency exemption Those were temporarily eliminated TCJ. Now, under OBBBA, they're permanently eliminated for 4 tax years after 2025. And for those taxpayers who itemize on Schedule A, let's now look at 2 significant changes for Schedule A filers. The first one is the home mortgage interest deduction. So the reduced dollar limit for home mortgage interest deduction on Schedule A, that is now permanent, meaning you can deduct qualified interest on acquisition debt for your home only up to $750,000 of acquisition debt, or half of that, $375,000 if married and separate. Also, the temporary suspension under prior law of the deduction of home equity loan interest, that suspension is now permanent. And then beginning with tax years after 2025 and 2026, taxpayers can again deduct mortgage insurance premiums for home mortgage interest. Now, the second bullet you see here, the change on Schedule A, change the state local tax deduction limit. This is really favorable for taxpayers. So those who itemize deductions and want to claim state and local taxes, that is temporarily increased for year 2025, 2029. So in 2025, the maximum deduction for state and local tax Schedule A was up to $40,000. Previously, it was capped at $10,000. For a couple qualifying separately, it's for 2025, $10,000, $20,000, and then 2026 it's going to be indexed for inflation. It will go up to 400, but remain the same next year. Actually, will go up by $200 next year for married filing separate, $20,200. However, and that will increase. That maximum deduction will increase by a percentage point each year for 2029. Now, one thing to keep in mind, there is a cap on this. Once you get above an MAGI threshold of $500,000 of modified adjusted gross income, then the SALT deduction is limited. It's reduced to 30%, 30%, by which taxpayers MAGI exceed that threshold. So for couples filing jointly, and other taxpayers, it's $500,000. Once you hit that MAGI threshold, you start to lose the full benefit of the SALT deduction if the SALT taxes are more than $40,000. So moving on to other provisions that are impacting families. Beginning in 2025, the child tax credit now increases to a maximum of $2,200 for each qualifying child under the age of 17. And that credit will be adjusted annually for inflation after 2025. And also, some other rules for these credits were permanent. There is, you probably know, a $500 credit for other dependents. Now that's made permanent. The income phase thresholds for the child tax credit will be at $400,000 for joint files, $200,000 for single filers. So once you're AGI above this threshold, the maximum credit stays out. There is a little portion. It's limited to $1,400 of the additional child tax credit. That's referred to as a refundable portion of the overall $2,200 child tax credit. And to start to get some of that refundable additional child tax, you have to have at least $3 earned income. Now, a taxpayer cannot claim child tax credit beginning in 2025. The return does not include the Social Security number of each qualifying child and Social Security number of the taxpayer, or if it's a couple filing jointly, at least one spouse has to have a Social Security number. And once again, that SSN has to be issued, be valid for work, issued before the return due date. Child and care credit. So between 2026, the maximum credit for the child dependent care credit that can increase to up to 50% of qualified expenses for those at the lower income level. That credit rate, 50% decrease by each percentage point for every $2,000 of ATI, adjusted gross income, above $15,000, but it will never until higher income levels are reached. And this change is very beneficial for those who are looking for work at a very lower income range. Flexible accounts for dependent care, very popular, offering to employers. Starting in 2026, taxpayers can contribute up to $7,500 per year to a dependent care flexible account. And if the taxpayers filing married filing separate, they can contribute half of that, up to $2,750 per year. Now, low cost and some other OBBA changes individual provisions. So, charitable donations. First, on this slide, I want to make 2 points about these changes to both charitable donations and miscellaneous deductions. These are provisions that begin this year, in January, on January 1st of 2026. So they're not applicable to the 2025 tax year. So for charitable contribution deductions, beginning in 2026, the 6% limit on cash charitable contributions made by an individual to a public charity, that 60% limit is now made permanent. Also, beginning in 2026, an individual who does not itemize deductions on Schedule A may also claim a qualified charitable deduction of up to $1,000 or double that, $2,000 or $20 for cash donations made during the tax year. So you want to look at changes next year on the 2026 1040 for that deduction. And this deduction for non-itemized qualified charitable deduction beginning in 2006, that's when calculating taxable income. It is not an above-the-line deduction in determining AGI. But again, that's all for 2026 return. Also, beginning in 2026, back to those who itemize deductions on Schedule A, they don't have a limitation. They will have to apply half a percentage point for to their overall charitable contribution. In other words, they'll lose the benefit of the first half percentage point of their charitable contribution. That calculation, presumably, we on the 2026 Schedule A. Miscellaneous itemized deductions, EJA, passed way back in 2017. There was already repeal of miscellaneous itemized deductions subject to the 2% AGI. Now that miscellaneous deduction, that is made permanent. So now taxpayers can, and this has been the case temporarily for the past few years, but now it's permanent. They cannot claim miscellaneous deductions Schedule A for things like job-related expenses or preparation fees. However, and you see this on the slide, teachers, or call them under statute eligible educators, they still will be able to deduct certain work-related expenses for books, supplies, computer equipment, literature used for instruction. So who is an eligible educator? Beginning as defined in our OBBBA, beginning in 2026, there will be a teacher and instructor, could be a counselor, principal, could be aide, working in kindergarten through grade 12. It could also include interactive sports administrators and coaches who at least 100 hours during the school year. So that's all for 2026. For 2025, those of you who do tax returns for teachers, educators, you're probably familiar with the above-the-line deduction of up to $300 for classroom expense, and that still is here. So some changes coming down the pipe in the future for educators, eligible educators, deductions. Now let me move on to Section 529 plans, which is now been around for ages. The maximum amount of qualified higher education expenses that may be used for a qualified tuition program, also referred to as a 529 plan, for elementary or secondary school enrollment, that maximum amount increases to $8,000 per student per year, and that will include students studying abroad. And the definition of qualified education expenses now it also includes qualified post-secondary expenses and other types of education costs that qualify for tax-free distributions from 529 plans. Remember, these changes that we're looking now in 2026, we can anticipate more IRS items coming later this year. Now, let's look at a change for 2025 for the adoption credit. And this is fairly significant, very favorable. These, after 2004, up to $5,000 of the adoption credit is refundable. This amount will be adjusted for inflation for tax years beginning after 2005. Now, the refundable portion of the adoption credit cannot be carried forward to future years. Only the non-refundable portion will be carried forward. Indian tribal governments now under one beautiful bill act have the same authority as the states to decide whether or not a children, whether a child has special needs for purposes of the adoption credit. And this is a beneficial change to government because it will allow them to recognize children with special needs and make them eligible for full adoption credit, similarly to the determinations made by any of the states. And the maximum amount of credit, or if it's provided through an employer-sponsored plan and exclusion, the maximum amount overall goes up to $17,280 per child, and that $17,280 will include both the refundable and the non-refundable portion. But there is phase out. This amount begins to phase out if you have modified AGI excess of $259,190, and then it's completely phased out at modified AGI of $290,190. Let me move on to some quickly to some individual changes involving disaster losses. The One Big Beautiful Bill Act extended the special rules for claiming qualified disaster-related personal and casualty losses that were created back in COVID legislation back in 2020, called the Taxpayer Uncertainty and Disaster Relief Act. So these rules under OBBBA, they cover disasters declared between January 1st, 2020 and September 2nd, 2025. And a temporary rule limiting personal casualty and death loss deductions to federally declared disasters, which makes it permanent. It's also expanded to include certain state disasters. Now let's look at some changes to energy credits. You may recall under prior legislation there were some energy credits. The first one was referred to as the clean vehicle credits. These have expired now. There was a credit under Internal Revenue Code 30 up to $700 for purchasing a qualified clean vehicle. That's gone. That's terminated for any vehicles acquired after September 30th of 2025. And then there's separately a previously owned clean vehicle credit under 25 Cat B. That also terminated after September 30th of 2025. And we to the fact sheet, which is referenced here, for more details. Fact sheet 2005-05. Let's move on to some changes to home energy credits. The energy efficient home improvement credit under 25 Cat C, that has ended for any qualified property placed in service after December 31st, 2025. So you would still see this credit being claimed on 2025 terms, but not for any improvements beginning in 2026. For the residential clean energy credit, which is code section 25 Cat D, that also is for any expenditures after December 31st of 2025. However, the credit remained at 3% of the qualified expenditures that were made before 2026, before this year, if the property was placed in service after 2021. So I'll refer you to the instructions for those credits. Now, moving on to get some more individual provisions before we get to our Q&A. Big change coming up in 2026 gambling losses. Beginning with tax years after 2025, taxpayers can deduct only up to 90% of their gambling losses, and only to the extent that those losses to exceed gambling winnings for the year. Previously, you could deduct up to 100% gambling losses against your gaming winnings, but that changes to only 90% of the deduction in 2026 against gambling winnings. Also, the legislation makes permanent the rule that this current gambling losses from wagering transactions, that includes any deduction normally allowed in calculating federal income tax has incurred while conducting wagering activities under Code Section 165.8. So this new deduction begins in 2026. It could mean, in circumstances, the 90% limit could result in taxable income to that gambler, even when there's no actual gain throughout the year. So, for example, the taxpayer wins $100,000, loses $100,000. Beginning in 2026, that gambler can only deduct $90,000 of those losses. It would create $10,000 of taxable income, even though the taxpayer broke even for the year under the Big Beautiful Bill. Savings credits for able accounts. Well, first of all, if you have a 529 plan, you can roll over amount in the 529 plan into an able account if the able account owner is in person and the designated beneficiary of the 529 plan, and the able account owner is a family member, or I should say, the able account owner member of the 529 plan. ABLE stands for Achieving a Better Life Experience. They help those with disabilities set up accounts that enjoy tax-deferred earnings. And now, as you see on the slide, there is a savers credit that will allow extra contributions to an ABLE account. That's made permanent in the existing employer law, now permanent, subject to certain limits. And the contributions into the ABLE account are eligible for separate credit, virtue of the retirement savings contribution credit, i.e. savers credit. So beginning in 2026, the maximum savers credit increases to $2,100. Two other OBA changes on our next slide. These are more narrowly focused. Military combat zones. In 2026, qualified hazardous duty areas are permanently treated the same as combat zones for tax purposes. So what this means is that members of the U.S. Armed Forces serving in qualified hazardous duty areas, they're going to the same tax benefits as those serving as in official combat zones. You see two country examples there of hazardous duty areas. One would be Kenya, the other will be Mali. Others permanently designated are Sinai Peninsula, Kenya, Burkina Faso, and Chad. So these service members would qualify for excludable combat zone pay from their income. Student loan discharge due to death or disability, beginning 2026, the exclusion from gross income from discharged student loan applies only to loans discharged either due to the death or their total or permanent disability. So this rule now is permanent, and there's no time limit on what discharge can occur. However, if this loan was to be charged and excluded from gross income, it would only apply if the taxpayer includes the Social Security number on the tax return for the year in which the discharge occurs. Now, let me pick three changes for health savings accounts. Under the One Big Beautiful Bill Act, we expanded access to health savings accounts through several changes. The legislation makes permanent the ability to receive telehealth and other remote care services before meeting the high deductible HDHP deductible while remaining eligible to contribute to an HSA. Remember, an HSA is a savings vehicle to put money to have it earn income in an account, and then the goal is to pull it out for health care expenses, but you have to align with a high deductible health plan. So for tax years beginning on or after January 2025, the individual can see telehealth or other remote care services and still be eligible to contribute an HSA. And they might not have been able to do that in the past. On the next slide, some other changes to HSAs. Beginning this year in 2026, enrolled in what's referred to as a bronze or catastrophic health insurance plan that obtained on the individual market. They may treat that plan as an HSA compatible high deductible health plan. And this applies even if the plan does not meet otherwise high deductible health plan requirements. So this is going to expand potentially the individuals who can contribute to HSAs if they're only covered under bonds or catastrophic health insurance plan. And these are plans that are bought on the individual market, but they could be bought on the individual market, but not bought on the individual market. They're only eligible to be treated by health plans if they are identical a plan is available on a state basis. And then our third slide, next slide I should say, is the change to health HSAs. Again, beginning in 2026, and otherwise eligible individuals enrolled in direct primary care service arrangements, they contribute to a health savings account. And they may also use their health savings account withdrawals tax-free to pay periodic primary care payments that are required by the primary care provider. On December 9th, 2025, we issued notice 2026-05, which you see referenced in the news release on the slide. We're asking for comments to March 6th, and then we'll issue. Upcoming in future years, let's turn now to credit. Credit donation qualified scholarship granting organizations. That's what I'm going to go through quickly because it really does not apply until 2027. So it's really important you're aware, and you can certainly anticipate more guidance from IRS later this year. Beginning after 2026, individuals may be able to claim a tax credit for qualified contributions. That maximum credit would be to $1,700 per year to a new designation referred to as a scholarship granting organization, or an SGO. But they don't exist yet, but they will come into existence once this provision is implemented following future guidance. And the scholarship amounts received by the taxpayer from an SGO, they will be excluded under related code section 130 and Cap 80. So I'm going to leave it at that. I want to turn now to some 26 changes impacting education. Employers, for many years, employers can offer give up to $5,250 tax-free per year towards their employee education expenses. And more recently, they could give up to $5,250 tax-free to loan payments if that includes repaying. Now that is made permanent, so that's different for employees who work for that type of employer. For the education credits claimed on Form 8883, that would be the American Opportunity Credit, Lifetime Learning Credit. You have to now include it also Social Security number and a school ID beginning 2026. And then I'm going to pivot now to the new Trump accounts, which are authorized under the One Big Beautiful Bill Act. Now, this is just for awareness purposes, a deep dive into the Trump accounts, because we have not issued regulations on these, but these are getting some throughout the country. They were created under Code Section 72, under Section 74 of the One Beautiful Bill Act. These allow a one payment under a program to the Treasury Secretary into a Trump account for an eligible child. Eligible child for purposes of the $1,000 one-time payment will be born between 2025 and 2028. And there was no prior election by anyone else other than the individual who's setting up the Trump account to accept that money into the Trump account. And that has to be a citizen. Separately, annual contributions to accounts will be limited to $5,000 per year. More information on Trump accounts on the next slide, as I just mentioned, $5,000 per year. Employers potentially can contribute half of that $5,100 for an employee or the dependent employee into a Trump account without it being included as taxable income to an employer. There are limitations on the investments under the statute. They're limited to certain investments in certain types of mutual funds or change trade like stock exchange, stock index, for example, Standard & Poor's 500. And then on our slide here, for Trump accounts, money has to stay in the Trump accounts generally until the year before the year the child turns 18, after which point the child is treated, or the account, I should say, is treated as an IRA. I encourage you to take a look at the new one, 4547, and its instruction for further guidance. And now, before we get into our Q&A, just to wrap it up, we have plenty of resources for you. On my final 3 slides here, on irs.gov, you go to irs.gov, roll down and you'll see a whole section on the One Big Black, all of the resources that I've been referencing today there. The 2025 instruction for the 1040 has OEDA material. On our next slide, you see an example of some of which I mentioned earlier. New releases throughout the year have been very, very active, with news releases, many of which tied to the more technical ones that our colleagues in Chief Counsel are working on, and from whom you'll hear in a moment. And then finally, on my last slide here, before I turn it back to Kenji, We have got some more items, including notices for relief from lenders, information reporting, for information reporting on no tax on tips, and on the occupations that customarily and regularly receive tips, and some information on the Trump accounts, all accessible at IRS.gov. So that's bookmarked by you for any information currently in the IRS on OBBA and forthcoming. And with that, I'm going to turn to facilitate our Q&A.
Amazing job, Richard. Hello again, it's me, Ken. I'll be moderating the Q&A session. Before we start, I want to thank everyone for attending and staying during today's presentation, understanding wonderful bill, individual tax provisions. We are now joined by an all-star of subject matter experts. Going from left to right, I would like to introduce each SME that has graciously agreed to join us today. First, we have Mikhail Zidkov, Senior Technician work for Employee Benefits, Exemption, and Employee Employment Taxes. Mikhail joined the IRS Office of Chief Counsel in 2017 as an attorney for the Employment Tax Branch 2. He was appointed as Senior Technician for the branch in 2022. The ITIN released the deduction for qualified overtime. Prior to joining Chief Counsel, Mikhail was a revenue agent for the IRS. Next is Robert Tusek, who is a special counsel with Income Tax and Accounting, IRS Office for Chief Counsel. Mr. Tusek has worked in Chief Counsel and IRS for over 25 years. A number of offices include Procedure Administration, Counsel to the National Taxpayer Advocate, IRS Collection Policy, IRS Affordable Care Act Office, Training Advisor to IRS Chief of Staff, IRS Office of and for the last 7 years, Counsel Income Tax and Accounting. Mr. Tusek has a Bachelor of Science from the United States Military Academy, a JD from Carolina Central University, and a LLM from Georgetown University. On our bottom left, we have Laura Daly. Laura is a special counsel, income tax and accounting. Ms. Daly has been with the IRS for over 20 years. In income tax accounting, she focuses on individual income tax issues and personal credit. However, during her career in Office of Chief Counsel, she specialized in procedural election and estate and gift tax issues. She briefly led Office of Chief Counsel to join the IRS Taxpayer Advocate Service and Taxpayer Experience offices. Prior to counsel, Ms. Daly served as an associate at Pointer and Spreel, LP in Raleigh, North Carolina, and a senior associate at PricewaterhouseCoopers in San Francisco, California. She received her undergraduate and law degrees from the University of Florida and her LLM in taxation from Golden Gate University. Last but certainly not least, we have Andrew Hollybeck, Senior Counsel for Employee Benefits, Exempt Organizations, and Employment Taxes, and joined the IRS Office of Chief Counsel in 2011 as an attorney with Employment Tax Branch 2. He was appointed as a Senior Counsel for 2018 and reviewed and helped draft guidance relating to the deduction for qualified tips. Prior to joining the IRS, Andrew worked as an interim planner for the city of San Antonio and Austin, Texas. One thing before we start, we know we can answer all these questions submitted, but we'll answer as many as time allows. That means have been actively in the chat and have selected many of your questions they would like to answer. So with that being said, let's go ahead and get started. First question here looks like this one. If a server, a single filer, receives 32,000 tips and has an MAG, how much can they deduct? I think this question is for Andrew.
Sounds like it's for me. So, as mentioned earlier, the deduction is limited at $25,000, and it's also reduced by $100 to $1,000, which is adjusted gross income exceeds $150,000, and then $300,000 for married filed jointly. So I think that the server receives $32,000 in tips already. That's limited just to the $25,000 maximum. And also, I think the income was $180,000, so that would exceed the point at which the phase out starts. So about $30,000 So if you do some math, I think the server can deduct about 22,000 in that case.
Great. Thank you for that, Andrew. Next question looks like it's on overtime. So we go to Mikhail, if I'm not mistaken. This is a two-part question. Mikhail, so the first question is, does the deduction apply to all overtime wages?
The deduction only applies to the premium portion, so the extra pay above the regular wages.
Okay. And then the second question is, if an employee earns $18,000 in overtime pay, how do they determine the deductible amount?
So for 2025, they must calculate the premium portion using payroll records or pay stubs. If the employer doesn't report it separately on Box 14. So more information is available in Notice 2025-69, and there's also some substance in the instructions to the Form 10-4 regarding some reasonable methods that might apply.
Thank you for that. Next topic here, let's take an introduction one. Laura, the question is, how much is the inherited deduction? And is it the same as the existing hunter deduction for taxpayers ages 65 or older?
The enhanced senior deduction is up to $6,000 per qualifying senior, and this is in addition to the existing standard deduction for taxpayers age 65 or older.
Thank you. Next question, let's go on no tax leave. Andrew, Neuron, can a part-time deduct tips that were pooled and redistributed?
Okay, so they can qualify tips. They include voluntary cash or charge tips for either receipt or also that received through tip sharing arrangements like the pool.
Great, thank you. Let's try one interesting question. Rob, I think that's your section. This question is a three-part. Is when is the deduction available?
It's available for tax years 2025 through 2028. That is unless Congress extends it at some point.
And does the deduction require itemizing?
It does not. Like all the other deductions we talked about today, both standard deduction filers and itemizers can take this if they're otherwise qualified.
And the last part of the question is, what is the annual deduction dollar limit?
It's an annual of up to $10,000 per year, and that can include on multiple cars if the loans qualify.
Let's come now to the enhanced senior deduction. So Laura, this is a question, so $12,000.
Meet the age and social security number requirements, and then file their non-joint tax return.
Okay, and the second part of that is, does the senior need to itemize?
No, the deduction is available whether they itemize or claim standard deduction.
Okay, thank you. Let's jump over to Andrew. If an employer doesn't separately report tip totals on an employee's form W-2 and 20, can the employee still claim deduction?
Yes, yeah, the employee definitely can. 25. There's really available with the tip amount isn't reported. The employee still can claim the deduction. If there's 68,69, we provide similes for employer qualified tips, and we can use their form 10, their form 47, which is the employee's report tips to employer, or whatever form they're using to report tips can use that to determine their to help how they're qualified as a mountain. And taxpayers can also use box 7 on Form W2. That's the box which tipped. That can also be used for calculating just in 2025.
Great. Thank you. And let's go ahead and next question on overtime. So Miguel, can union overtime paid under contract qualify?
Only to the extent it meets the federal definition of qualified overtime compensation. So if contract provides for times overtime for every hour worked over 40, only half of that amount might be deductible.
Thank you. For senior deduction, so this is Laura. What happens if the senior's MADI exceeds 75,000 if single or the 150?
Deduction will phase out if they're much above those thresholds.
Thank you. Now let's go back to Rob and just get a Carlo deduction question here. So for this one, for a married couple, 2 vehicle loans, is the deduction dollar limit per vehicle or per return?
That limit is per return. So it's for people, regardless of the number of vehicles, they can deduct up to $10,000 of vehicle loan interest.
Okay, and Rob, another question: are married taxpayers filing jointly with the modified basic income of more than $210,000 eligible for this deduction?
Yes, but they may be partially phased out. For married filing jointly taxpayers, the deductible amount of interest begins to phase out at a modified adjusted gross income that exceeds $200,000. So they're just above the limit there. But
sorry, you can go on.
Oh no, I was going to say that they're just above the limit, but they can still deduct, a good portion of that interest. But they start to phase out at $200,000.
Got it. Thank you. Take a note on 2 questions. I got 2 questions here, Andrew. First one, do mandatory service charges qualify as tips for purposes of the deduction?
No, the answer only voluntary tips qualify. So the mandatory service charge, like a restaurant, for parties of a certain mandatory charge, those do not qualify as qualified tips for purposes of the deduction.
Can a self-employed hairstylist deduct more tips than their net business income?
No. Employed for some employed individuals, the deduction is limited to exceed their net income from the trade business in which they're receiving.
Okay, thank you. Let's jump to a no tax overtime question. Miguel, if a worker has multiple employers, do all time amounts count from each employer?
They could if each of them meets the qualified overtime compensation definition, which is required under federal law. Then those amounts can be combined, and the combined total can't exceed half that for a single taxpayer, 25,000 for taxpayers filing jointly, and those are subject to the modified adjusted income limits over 50,000 and 300,000, depending on filing status.
Now, are employers required change studying for 2020?
No. Transition gas states forms remain for 2025.
Laura, let's pick a question from the senior deduction topic. Can a senior without a valid Social Security number claim the deduction?
No, a Social Security number valid for employment and issued before the return date, including expenses, is required.
Okay. And if only one spouse age 65, can they claim the deduction? So, for example, one spouse is 4 years old and the other is 65.
Yes, the deduction is calculated per qualifying individual. So the one spouse who's 65 has a Social Security number valid for employment and issued before the due date of return could claim up to $6,000, provided the spouse has filed jointly. And then the spouse who's age 64 does qualify and cannot claim the enhanced deduction on their part of the joint return.
Does claiming the enhanced deduction affect the eligibility for other credits?
It could. Claiming the credit with income, which may indirectly affect calculations.
Okay. Through a car loan interest question, Robin, is interest paid on a loan originated in December 2024 eligible?
No, the statute requires that the loan has to originate after December 31, 2024 to qualify.
If the taxpayer used a home equity loan or equity line of credit to purchase a car, is the interest paid on that loan eligible to be deducted as a qualified car loan interest?
No, actually, interest has to be paid on, to be deductible, has to be paid on a loan that is secured by a first lien on a purchased vehicle. Interest paid on loans secured by the taxpayer's home are not eligible to be qualified car loan interest under 163H4.
Okay. Let's go for a tax question. Andrew, reported on Form 4137, Social Security and Medicare tax on under income still qualified?
Yeah, they can. So for employees who report their tips directly to us on Form 4137, and include that in their income, the amounts can be, those amounts are qualified.
Okay. Now, if a worker changes jobs mid-year, do tips count?
Yeah. So it qualifies as received across all sources. From my are eligible for the deduction, of course, subject to the $25,000 limit and all other applicable limitations.
Okay. And last question here: does the deduction apply to FICA tax?
No. The deduction is really for federal income tax only. So the FICA tax is Social Security, Medicare. The taxes will apply.
Great, thank you. So, audience, that is all the time we have for questions. I want to thank Richard for such a presentation, along with the members of council, answering your questions and sharing their knowledge and expertise. Before the Q&A session, Rich, what key points do you want the attendees to remember from today's webinar?
Well, thank you, Kenji. I've seen today one big the Bill Act sends many of the individual provisions of the Tax and Jobs Act of 2017. However, it's also eliminated certain individual home energy and clean vehicle credits that were in that legislation. And use for all IRS guidance on the legislation is irs.gov/OBBB. And finally, the thing I had out of order, I apologize. Remember the new Schedule 1A, additional deductions, where you'll calculate the no tax on overtime, no tax on interest, and the enhanced deduction for seniors. And as we emphasized throughout today's session, these deductions may be claimed both by itemizers. So I want to thank everyone. I hope you have found the session beneficial. Let me turn it back to Kenji to wrap up.
Thanks, Rich, for those key points. Audience, watch for announcements on future webinars. To register for any upcoming webinar, please visit irs.gov, keyword search webinars, and select the webinars for tax practitioners or webinars for small businesses. When appropriate, we will offer certificates and e-credit credit for upcoming webinars. We invite you to visit the IRS YouTube page at www.youtube.com/IRS videos and view available recorded versions of our webinars and other once posted. Again, continuing education credits or certificates of completion are not offered if you do an archived version of any of our webinars. Another thank you to our presenters and subject matter for a great webinar and Q&A. I also want to thank you, our attendees, for attending today's webinar, Understanding the One Big Beautiful Bill, Individual Tax Provisions. Remember, if you attended today's webinar for at least 100 minutes till start time and answered at least 4 polling questions during the live broadcast, you will receive a certificate of completion for 2 IRS credits, or if you attend for at least 50 minutes after the official start time, answer at least 3 polling questions during the live broadcast, you will receive a certificate of completion for 1 IRS credit. Remember, the polling question example will count towards the minimum question response requirement. Certificate of completion will be emailed to the registration email address of qualifying participants as a PDF attachment. The email will come from the email address in the slide. Please add this email address to your contacts to ensure you receive the email with the certificate attached. If you qualify for IRS continuing education credit for this webinar and register with your valid first name, last name, and ITIN as it appears in your IRS ITIN account, it will be posted in your IRS account. If you are eligible for continuing education from the California Tax Education Council, your credit will be posted to your account as well. If you qualify and have not received your certificate and/or credit by March 15th, please email us at cl.sl.conference.team@irs.gov. The email address shown. If you are interested in finding out who your local stakeholder liaison is, visit us at irs.gov or send an email to the address shown and we'll send you that information. We would appreciate it if you would take a few minutes to complete a short evaluation before you exit. If you have more sessions like this one, let us know. If you have thoughts on how we can make them better, let us know as well. If you have any requests for future webinar topics or pertinent information you'd like to see in an IRS fact sheet, tax tip, or FAQ on irs.gov, then please include your suggestions in the comment section of the survey. Click the survey button on the right side of your screen. Not come up. Check to make sure you disabled your pop-up blocker. It has been to be here with you and have the Internal Revenue Service and our presenters. We would like to thank you for attending today's webinar. It is important for the IRS to stay connected with the tax professional community, individual taxpayers, institutions, along with the federal, state, and local government ordinance. You make our job a lot easier by sharing information that allows for tax reporting. Thanks again for your time and attendance. We hope you find this information helpful. You may exit the webinar at this time.
Hi, I'm Becky. I work for the Internal Revenue Service. If you're a longtime business owner or just thinking about starting a new venture and work for yourself, you should know about the IRS Small Business and Self-Employed Tax Center. This online tool is your one-stop resource to help you learn about the tax issues involved in owning your own business. To access the site, visit irs.gov/smallbiz with a Z. Here you'll find information organized in 6 categories for every phase of your business. For example, you'll find topics on selecting a business structure, differentiating between a business and a hobby, even a checklist for starting your business. You can click on the A to Z index of business for an alphabetized list of more than 50 topics. There's also a link to our contact center if you're involved in this quickly growing business activity of your online platform to sell a service such as renting a room or providing car services. And if you're thinking about hiring employees, scroll up to our popular topics section and click Employer ID Numbers. For some questions is if you need materials such as schedules, C, E, or F. Here you will find Publication 45991, Small Business Federal Tax Responsibilities. You can get information on preparing your taxes, including an overview of tax credits and deductions, such as business or home. Plus, you can learn about record-keeping requirements to help you track your expenses and about making federal employment deposits. We also have an online learning section where, if you click IRS Video Portal, then the Business tab, you'll find audio and video programs on topics such as of retirement benefits, how to avoid being a victim of a tax scam, and small business virtual workshop lessons. If you prefer to go to an in-person workshop, then visit the Small Business Event section to locate a partner seminar, which may include IRS presenters. And consider subscribing to eNews, which provides information about tax dates and what's new for small businesses. Now, if you're working for yourself, click on the Self-Employed link. Or if you're not already on the IRS site, just type irs.gov/employed. Here you find publishes filing requirements and payment obligations, along with tips on selecting a tax professional. You may also check if irs.gov has resources specific to your type of business. For example, there are tax centers devoted to day providers, truckers, to name a few. Type in the keyword tax centers in the search field to see the complete list. So whether you're self-employed or starting or maintaining your own business, Small Business and Self-Employed Tax Center is the place to start. Visit it at irs.gov/smallbiz.
In this video, we'll discuss what to do when you receive a tax document, 99 DIV or 1099 INT, that shows taxes paid on the income earned. For example, you receive the Form 1099 DIV that shows you earned $1,000 of the income earned. $100 of foreign taxes were withheld and paid. Identify the foreign country. In our example, Australia. Generally, you may claim foreign tax credit on your U.S. individual tax return for withholding taxes imposed on dividend income, but only to the extent you are legally liable for that tax. The withholding tax rate is based on the internal tax law of the foreign country, unless a tax treaty within the United States and that foreign country establishes a different withholding rate. Many country treaties with the United States. Depending on the treaty, eligible residents or states may be taxed at a reduced rate or foreign taxes on various types of income earned in these foreign countries. Many tax treaties establish reduced tax rates for dividend and interest income. By the way, when we say foreign tax paid, as in box 6 of the Form 1099, it means the tax was withheld and then paid over to the foreign country, or a withholding tax. So, how much of the $1,200 foreign tax paid in the example are you legally liable for and able to claim as foreign tax credit? In order to answer that question, you need to first determine if the amount of foreign tax shown in box 6 over the withholding tax imposed on the dividend in that foreign country. Let's look at the Form 1099 again. It was $1,200 of foreign tax paid to Australia on $4,000 of dividend income earned in that country. The first question to ask is there a tax treaty between Australia and the United States that reduces or even eliminates the normal Australian withholding tax rate on dividends earned in that country?
Information on tax treaties and trade withholding tax rates can be found on the IRS website. To locate this information, go to irs.gov. In the search bar at the top right side of the screen, type Tax Treaty Tables and click Search. Tax Treaty Tables Internal Revenue Service should be the first that appears on the list of search results. Click on this link. On the next page, scroll down to Table 1 and click it. Table 1 lists the treaty tax rates for certain types of income earned in these foreign countries. Column 1 lists the names of the foreign countries with which the U.S. has tax treaties. For our discussion, focus on the second and third columns, which show interest and dividend income. Notice that right next to the rates are alphabetic notations. These represent footnotes at the end of the table. This table is reference because the rates for each country for income are shown in one place. If you need to look for additional information within the treaty itself for a specific type of income, the table lists the relevant treaty articles. This table shows the treaty holding rates from the U.S. perspective. But these rates are generally reciprocal, meaning the same treaty rate applies to both the United States and the foreign country on the sum earned in its respective countries. If in doubt, always consult the tax treaty itself. To locate a specific treaty article, go to the IRS.gov. Type the name of the foreign country in the search box. Australia is the foreign country in our example, so let's type in Australia. When the search results appear, look for the link to the tax treaty document for that country and click. Multiple documents may appear on the search list for the country. Always select the link to the income tax treaty document for the most recent year. What if the foreign country shown on the Form 1099 is not listed on Table 1? It could mean the United States does not have a tax treaty currently with that foreign country. To be certain, you should look at the tax treaty with the specific foreign country in question. By the way, we'll look at Australia as the foreign country in our example for more than the fact that it is the first country listed on Table 1. If there was no tax treaty between Australia and the United States, the entire amount shown in Box 6, or $1,200, would be eligible for the foreign tax credit. But Australia had a treaty with the United States, and Table 1 shows a lower treaty rate of 15%. You earn $4,000 of dividend income in Australia, and since the applicable treaty rate is 15%, your legal liability for foreign tax on that income is $600, or $4,000 times 15%. Therefore, $600 is the amount of foreign tax eligible for the foreign tax credit, not the $1,200 shown on Form 1099 DIV. Let's look at another example. Instead of a Form 1099 DIV, you receive a Form 1099 INT that reports interest income earned from a foreign investment. The interest income is $4,000, and the foreign tax paid is $1,000. The investment is in Austria instead of Australia. Again, Austria as the foreign country in this example for no particular reason other than it is the second country listed on Table 1. So we go to Table 1 and find a line in the table for Austria. Instead of looking at the dividends column, we now look at the interest column. In this instance, the treaty rate for tax withholding on interest is 0. This means the amount shown in Box 6 should be 0, because under the tax treaty with Austria, you have no legal liability to pay any foreign tax on the income earned in that country. Consequently, none of the $1,000 in Box 6 can be claimed as a foreign tax credit. We strongly recommend you visit the IR.gov website and review the treaty with a specific foreign country. By now, you may be wondering why so much more tax actually withheld and on your Form 1099 DIV or Form 1099 INT. The treaty specified a reduced withholding rate. And more importantly, what can you do about the amount that was overpaid? First, if the withholding agent did not verify your status as a U.S. resident or citizen eligible for a reduced treaty withholding rate, it will withhold at the foreign country's higher rate on its internal tax law. You should contact your financial institution with any questions concerning foreign withholding on earned in foreign countries. Note that in certain countries, you may be able to provide a withholding agent with certain forms indicating that you are eligible for a reduced rate of withholding at source pursuant to a treaty. Second, if you are not able to provide the withholding agent with required information to reduce the rate of withholding at source, you may be able to file a tax return with the foreign country to obtain a refund of the excess withholding tax. In such case, you will likely have to demonstrate that you are a U.S. resident, as defined by the applicable treaty, and satisfy the requirements for obtaining the particular benefit provided by the treaty. Important point to understand here is that the withholding tax in excess of what you are legally required to pay to a foreign country cannot be claimed as a foreign tax credit on your individual U.S. income tax return. In summary, when you receive a Form 1099 DIV or 1099 INT, that is a foreign tax paid in Box 6, foreign country in Box 7. Refer to the Tax Treaty Table 1 on the IRS.gov website for a quick reference. The amount of foreign tax paid that is eligible for the foreign tax credit is based on the reduced treaty rate, if a treaty exists and you are eligible for a benefit, regardless of what was actually paid or withheld per Box 6 of the Form 1099. For more information, go to irs.gov or irs.gov/foreign tax credit.
International, do you receive income from a foreign corporation or is part of your business located outside the United States? If so, here's a deduction and a couple of taxes you might not be aware of. First, in general, you can count the dividends you receive from foreign subsidiaries. Next, the first tax is a tax on global intangible low-tax income. Generally, this is income from foreign assets such as patents, trademarks, and copyrights. The tax on global intangible low-tax income only applies if you are a U.S. shareholder who owns at least 10% of a controlled foreign corporation. You need to include this income as part of your taxable income every year. This rule applies even if the corporation does not distribute income to its U.S. shareholders. Second tax, the base erosion and anti-abuse tax, also known as BEAT. It mostly affects U.S. corporations that make deductible payments to foreign-related parties. It applies if your corporation has gross receipts of more than $500 million over a 3-year period. For more information, go to irs.gov/tax reform, then select international businesses.
Hi, I'm Lisa, and I return revenue service. If this is your first time filing a federal tax return, it may seem overwhelming, but it doesn't have to. Especially if you IRS Free File. With Free File, you get access to tax preparation software and electronic filing free of charge through a partnership between the IRS and tax software companies. To get started, visit irs.gov/free file to see a list of choices. Now, you probably receive forms such as a W-2 or 1099 or both. Tax software like Free File will print information from these forms to complete your tax return. If you're a student, the software will ask you to enter tuition fees information from forms like the 1098-T and then see if you're eligible for any tax benefits. Free File is offered exclusively through the IRS website. The great thing about Free File is it will do the math for you. It will help you avoid errors, and it will find all the credits and deductions you're eligible for. On the other hand, if you would like to have an IRS trained volunteer help you prepare and e-file your tax return, check out Volunteer Income Tax Assistance Program. Go to irs.gov/VITA to see if you qualify and to find the location of the site near you. If you want to hire a tax professional to complete your tax return, make sure you pick someone you can trust. You are responsible for the information on your tax return, no matter who files it for you. You can search tips for choosing a tax professional and avoiding return preparer scams at irs.gov/. No matter which method you choose to prepare your tax return, e-file is the best way to file an accurate tax return. And combining e-file with direct deposit is the fastest way to get your refund. You can check the status of your refund by using the Where's My Refund tool at irs.gov or on the IRS to Go mobile app. If, on the other hand, you owe additional taxes when you file, you can make a payment using IRS Direct Pay. Go to irs.gov/payments. Pay what you owe at the April deadline to avoid payment interest. And while you can get an automatic 6-month extension to file your tax return if you need more time, this is not an extension to pay any taxes you owe. Finally, remember to protect your sensitive personal financial data and beware of tax scams. If IRS needs to contact you after you file your tax return, you will probably receive a notice in the mail first. Scam artists often impersonate the IRS by phone, email, and social media. Try to steal information such as social security numbers, account numbers, or credit cards. Be careful and get to know all the resources available to you at irs.gov.
The instructions in this video are up to date. However, your form may look different from the image shown. Please visit irs.gov/OIC for the current form and more information.
Do you owe money to the IRS and are unable to pay the full amount? If so, you may be eligible to settle your tax debt for less than you owe. It's called an offer in compromise, or OIC, or offer. You can submit an offer yourself, or you can hire someone to help you. So, what is an offer in compromise? Here is a brief explanation. An offer in compromise, or offer, is an agreement between you, the taxpayer, and the IRS that settles a tax debt for less than the full amount owed. To be considered generally, you must make an appropriate offer based on what the IRS considers to be your true ability to pay. This video playlist will lead you through a series of steps and forms to help you calculate an appropriate offer based on assets, income, expenses, and future earning potential. We'll then walk you through the actual Form 656, offer in compromise itself. And finally, we'll go through a checklist to ensure you're including everything you need to get your process to go smoothly. These steps to make an offer. Before you start investing time to do the paperwork necessary to submit an offer, you'll want to check out the IRS's Offer in Compromise Pre-Qualifier tool to make sure you're eligible to file one. Find a link to this tool at www.irs.gov/OIC. Note, even though individuals and businesses can submit an offer, the tool is currently only available to individuals. Now is also a good time to review the information on irs.gov. Simply use the search term OIC. You'll want to review the questions most people have about offers. If you feel you meet eligibility requirements to submit an offer, the next step is to visit irs.gov/OIC to download the most current Form 656 offer compromise book. It is important to make sure the most current version of the booklet to avoid unnecessary issues with processing. There is an application fee to submit an offer and compromise, and you must submit a down payment unless you qualify for the low income certification or submit a debt to liability offer. Check the most OIC Form 656B to get the current fee. The booklet contains the OIC application form and other forms you'll need to submit your offer, whether you're an individual or a business. The forms include Form 433A OIC, Collection Information Statement for Wage Earners and Self-Employed Individuals, Form 433B OIC, Collection Information Statement for Businesses, Form 6, Offer and Compromise. Note, this form is located after Forms 433A and B OIC. It's helpful to complete the information statement forms first before you complete Form 656. Each of these forms helps you determine a potential offer amount on your assets, income, expenses, and future earnings. Be sure to read the instructions in the booklet, especially the 7 steps it lists as the application process. Before you watch the next video, be aware that if you or your business is currently in a bank proceeding, you are not eligible to apply for an offer. Also be aware that a separate application is necessary for each tax entity. For example, each individual taxpayer or non-sole proprietor of business, such as a corporation or partnership, wanting to submit an offer for consideration needs its own application. If you are an individual taxpayer, including one who is self-employed or is a sole proprietor, please watch the next video on completing Form 433A. If you are submitting an offer for a business only, please skip to the next video and watch the third video in the playlist on completing Form 433B. There's also a final OIC package checklist video in this playlist for you to view. Note, if you are working with an IRS employee, let them know you are sending or have sent an offer to compromise your taxes. This ends the video. Thanks for watching.
How to complete Form 433A by IC.
The instructions in this video are up to date. However, your form may look different from the image shown. Please visit irs.gov/OIC for the current form and information.
Let's show you how to complete your Form 433A OIC. This form is also about 8 pages long. You'll need to complete Form 433A if individual, such as a wage earner or a sole proprietor. In an effort to keep this video short for your viewing, we've gone ahead with the form, and we're just going to go through what that looks like. Personal and household information. Section 1 is going to be your big personal and household information. You're going to put in your personal information. Mark the marital status box and add your spouse's info and marriage date if you're married. Make sure to include all required info regarding your spouse, even if the person is not liable for the tax liabilities. Mark if you own home or rent it, or if you have a different living situation, such as sharing rent or living with a relative, you'd mark the other box. You're going to put in your children's or others living in the household names, ages, and relationships. And then there's two boxes over here. The first one is whether or not they are claimed as on your Form 1040. If they're not, and you mark no here, just know that you are not going to get credit in the offer process for any expenses related to them unless there's court-ordered child support. Then you also need to answer whether or not the people listed contribute to the household income. If you're sharing household expenses, you must disclose that on this form. These particular taxpayers don't have any dependents. Section 2. Information for wage earners. Employment information for wage earners is next in Section 2. Here is where you list employment information for wage earners. This is where you're going to put in your and your spouse's employment information, how long you've been employed there, have any ownership interest in the business, and your occupations. It's important to disclose any business ownership interest in this section. Section 4 will also allow you to provide information in your business when you don't wage from that business. Personal assets information. Move on to Section 3. This is where you're going to list your personal asset information. I've gone in and filled this out as a fictional example. Oftentimes, taxpayers submit an OIC. Leave this section blank. You'll want to make a listing all your personal assets requested in the section. A quick tip is that if you don't have any assets or income in a certain category, put NA or none in the appropriate subsection. You don't want to appear as if you skip a question. Personal assets checking. These fictional taxpayers have a checking account with some national bank with $1,500 in it. They also have a savings account with some national bank with $20 in it. So the total of the two accounts is $1,520. However, right here, it tells you to add lines 1A through 1C. 1C is going to be if you have more than two bank accounts, in which case you would add an attachment providing all this information on those other bank accounts and then put that total there. For line, we're adding 1A through 1C, and you're going to subtract $1,000. To assist you with your living expenses, IRS gives you $1,000 credit. In this, out of the $1,500 these fictional taxpayers have in their bank accounts, we're only putting $520 on line 1. Error to avoid. You must list all your bank accounts on this form. Joint accounts must be listed. And you'll need to provide documentation for account listed on the collection information statement. Also, your organization will need to address any deposits in your bank accounts if they're not from your reported income sources. Personal assets, investments, insurance. Moving on down, we have investment accounts. These fictional taxpayers have an investment account that has a current market value of $2,000. Make the quick sale value, which is 80% of the current market value, and that's $1,600. There's no loan balance here, so they have $1,600 that will be included for the account. So that's going to come down to line 2 because that's the only item they have here. And then we're going to move into retirement accounts. There's a retirement account with a current market value of $5,000. Multiply this by point sale value of $4,000. However, these fictional taxpayers have a $3,000 loan against their 401k retirement account, leaving it with an actual market value of only $1,000. That's the only retirement account they have. So we're going to bring that down to line 3, which I'll also highlight as important. Next section is cash value of life insurance policies. Be sure to put the cash value of the policy here, not the face value. This is for whole life policies only. If you have a whole life policy, you'll need to put that here. If you have a term life policy, do not include that here. Say that the additional taxpayers don't have any insurance policies. So we write NA at the beginning of the section and do not write anything on line 4. Personal assets, real estate. Continuing section 3 with your personal asset information, we're next going to include your real estate information. List your real property here. That includes any house, condo, co-op, timeshare, etc. that you own or are buying, including any assets owned by your spouse if you live in a community property state. Community property states are Arizona, California, Idaho, Louisiana, New Mexico, Nevada, Texas, Washington, and Wisconsin. The U.S. territories of Guam and Puerto Rico are also community property jurisdictions. Community property taxpayers often seem unaware of community property laws that can lead to assets owned by a spouse being left off this financial statement. So you're going to put in your address of your primary residence and date of purchase in this section. Include the county, date of final payment, how the title is held of property. Most cases, this is going to be a single family home. You own a condo, duplex, or something else. Then you're going to put in that description here so that the IRS has the description of it. For current market value, you can use online appraisal tools. An average of those online appraisal tools estimates or the market value on an appraisal if you had one done recently. We advise against using only the tax assessor's estimated value for real properties. In this example, the current market value is $300,000. Again, we get to use the value here, $300,000 times 0.8. That equals $240,000. This particular property has a mortgage balance of $160,000. So there is no equity, and the value is listed as 0 in line 5A. Do this a negative number. If you have more than one property, you would continue to fill this out. You can add an attachment if you need to, and then all of those properties are totaled on line 5 here. Personal assets. The next for our personal assets is going to be vehicles. Be certain to list all vehicles you own. We use research tools to verify information on your collection information statement, and we will pick up vehicles registered to you. So you're going to put in the vehicle's make, model, the year, the date it was purchased, and current mileage. Include whether it's a loan or a lease, who the creditor is, date of final payment. In the amount of the payment, you're going to do the same thing here with the current market value as you did before for real property. Online auto appraisal tools are a very good place to put current market value on a vehicle. It's usually pretty accurate if you put information. So, this first fictional vehicle has a current market value of $4,000. Quick sale value at 80% gives us $19,200. There is a loan on the vehicle of $15,000. The vehicle have equity $4,200 on line 6A. Now you see right here on line 6B that it tells you can subtract $3,450 from line 6A. If it's a negative number, put 0. So if you are a single individual filing an offer in compromise, you can subtract $3,450 from this $4,200, bringing that total to $750 on line 6B. Note that if the equity is less than the $3,450 exemption amount, you can't put down a negative number, and you should just put 0. Now, this fictional taxpayer's spouse also has a vehicle, so we put in the information for the other vehicle. This one does not have a monthly loan payment, has a current market value of $12, and a quick sale value of $9,600. We've brought that over here on line 6C since there is no loan balance, and it tells you on line 6D if you are filing a joint offer to taxpayers, then you can subtract $3,450 from the vehicle. This is a joint, so we're going to subtract the $3,450 from the $9,600, giving us $6,150, which we 6D. And then line 6E is any other vehicles you own, and we told line 6B, 6D, and 6E bring us to $6,900 for the vehicles. Personal assets, collectibles, jewelry, artwork, gun collections, etc. Section 3 continues and addresses the current market value variety of personal assets, beginning with your collectibles, jewelry, items you have in a safe, gun collections, and any you may have. In community property states, if you offer for just your tax liabilities, you need to also include your spouse's community creditors could collect. Moving along, you need to assume to your less valuable fictional taxpayer doesn't have any specific collections. They just have their general household items. We've just put in a value for miscellaneous household items. The best way to come up with the market value on this is to go through and figure out if you were to put everything in your house out on your yard and have a yard sale, what would you bring in from that? And that's going to be the best way to come with your current market value if you don't have any significantly valuable pieces. We're going to say that this fictional taxpayer has general household items valued at $8,000. Our quick sale value at 8% is $7. Our fixed taxpayer does not have, so we enter $6,400 on line 7A. We subtract the $9,690 IRS deduction from the sum of line 7A, 7B, and 7C, which lowers the amount to 0 to be entered on line 7. Now this brings us to our box A, which is available individual equity and assets. It tells you here, do not include amounts on the line with a letter to set the number, and round to the nearest whole number, but do not enter a negative number. And then it tells you here, add lines 1 through 7 and enter the amount. Be sure to carry the number in box A over to section 8 to calculate your minimum offer amount. Wrap up personal 7. So now you'll see I'm going to scroll up here really quickly. I highlighted all the lines we're going to add up. So 1, 2, 3, and 4. We have $520, $1,600, $1,000, and $0. And going down further, we don't have anything on line 5. We have $6,900 on line 6 and $0 on line 7. And that gives us a total of $10,020 in available individual equity and assets. This ends the personal assets information portion of the form. Self-employment business asset and expense information. Section 4, 5, and 6 ask for information of employment. Information asked for in these sections are very self-explanatory, so we're not going to fill them in today for this video, but I'll give you a few tips to help you if you need to use these parts of the form. Self-employment information. You'll need to complete this section if you or your spouse is self-employed. That is, if you file Schedules C, E, F, etc. Because the questions in these 3 sections are self-explanatory, I'm not going to fill them in for this video. Section 4 only asks for basic information, such as name, address, and phone number of your business. It also asks if you have employees and make tax deposits. Also, if you or your spouse are involved in any other business interests, including an LLC, LLP, corporation, partnership, etc., you'll need to add that information in this section. Business asset information for self-employed. In this section, business assets such as bank accounts, virtual currency or cryptocurrency, tools, book, machinery, equipment, vehicles, and real property that is owned, leased, or rented. If additional space is needed, attach a list of items. Do not include personal assets listed in section 3. You'll want to round to the nearest whole dollar, and do not enter any negative numbers. If any line item is a negative number, enter 0. Also, a quick reminder here, if you are self-employed and have accounts or notes receivables, be sure you check the box. Taxpayers often don't check the box to let the IRS know if they have accounts or notes receivables. Business income and expense information for self-employed. Information for this section is basically going to come off your statement if you're self-employed. So you'll plug those numbers in here. If you provide a current profit and loss statement for the information in this section, enter the total gross monthly line 17 and your monthly expenses on line 29. When you do this, you don't have to complete lines 12 through 16 and 18. You may also use the amount claimed for income and expenses on your most recent Schedule C. However, if the amount has changed significantly within the past year, a current profit and loss statement should be submitted to substantiate the number on this form. And again, round to the nearest whole dollar and do not enter any negative numbers. If any line item is a negative number, enter 0. Monthly household income and expenses. We get to 7, which is going to be your monthly household income and expense information. You make $4,500 gross wages a month, and your spouse $1,000 monthly gross wages. If you have other household income, whether it is a non-liable spouse that's not involved, interest and dividends, distributions, or net rental income included here. If you're selling, then you're going to pull that number from box C on the prior page for your business income and plug it in here on line 36. Also, if you own a corporation, don't list corporate income and expenses on the Form 430A OIC. These should go on Form 430B OIC. Next, you'll add any child support or alimony that you receive. The total household income in this fictional case is going to be $8,500, which you will enter in box D. Be sure to list gross monthly income rather than using net income or annual income figures, and use the most current information instead of information from last year or prior years. Note, your entire income should also include income that is considered not taxable and may not be included on a tax return, and the express date of this information later. That's going to move us down to our monthly household expenses category. You'll see this note here where it says for expenses claimed in boxes 39 and 45 only, the amount of the allowable standard, even if the actual amount you pay is less. And then it tells you where you can find these allowable standards. Just search the term financial standards on www.irs.gov and it'll pull up the collection financial standards page. So you'll want to make sure that you look at those numbers. Here, for the food, clothing, and miscellaneous, I've pulled the allowable standard for a household of 2 individuals based on what we fill out on the first page of this form as $1,298. I've brought in housing utility expenses for $1,895 a month. That's going to cover it. It's also going to cover all their monthly costs of property taxes and internet bills. Next, I've included the loan or lease payment that we calculated earlier at $500 a month that was on the first vehicle. Then we have vehicle operating costs of $462 and no public transportation. These fictional taxpayers pay $1,000 a month for their health insurance premiums and are allowed $112 a month for out-of-pocket health care expenses. Again, the out-of-pocket health care expenses on line 45 come directly from the standards. You can use the number from the standards even if you pay less. That's the standard allotment. There are no court payments, no child care, no term life insurance. They're paying $489 a month for state income taxes, $2,040 a month for federal income taxes, and they do not have any secured debts or state taxes. Please, card payments and unsecured loan payments are not considered to be secured debts. So, totaled all these expenses, get total household expenses of $7,796 in Bucks E. We had $8,500 of income, so now we have a remaining monthly income $704 for box F. Calculation of minimum offer amount. Now, you're getting to the point in section 8 here where you're actually going to calculate the minimum amount you can offer. There are two different calculations here. And it's to tell you right here, if you will pay your offer off in 5 or fewer payments within 5 months or less, that you're going to multiply box F, $704 by 12 to get $8,448 in box B. So now we are looking at box A, which is $10,020 equity in assets. Again, that is coming from right here on page 48, box A. So that's our $10,020, and then we enter here our $8,448. Let's say that we're going to pay this in 5 or fewer months. That is going to give us a total offer of $18,468. If you want to pay the preferred amount in 5 or fewer months, you will transfer $18,468 to the form 656. If you will pay your offer in 6 to 24 months, then you're going to multiply box F, the $704 by 24 to get $16,896 in box H. It's going to be $6,896 plus $10,020, which gives us an offer of $26,906. If you want to pay the offer amount in 6 to 24 months, you will transfer $26,906 to the form 656. This is important. Your offer can't be zero, and you can't leave the offer amount blank. Section 9. Other information, including yes and no questions everyone should answer. Then you're going to move on to section 9, which is other information. These are some basic yes or no questions that you're going to want to go through and answer. One thing to note in this section is transfer of assets for less than full value. In the past 10 years, have you transferred any assets with a fair market value of more than $10,000, including real property? Some taxpayers mistakenly place their primary residence here, as it was sold for less than the purchase price due to decrease in market value. Many taxpayers sell their assets for an amount lower than what they're worth to family members or others to keep them out of the offer calculations or out of the IRS's reach. Depending on the facts, the IRS may consist as concealing assets, which may lead for individuals to fines of up to $100,000 and imprisonment up to 3 years. With records and ability to research past business transactions, the IRS can find out about these types of transactions. The IRS may treat this as if you still have the value in the asset when vetting your offer amount. Checklist of necessary attachments, signature, and date. Section 10 is where you're going to sign and date it. A common error IRS sees is people not signing their form. And then down here, it's going to give you a checklist of items that you need to attach and make sure that you verify submitting this OIC. Go through and make sure you have all these items checked off and you're including them when you submit this offer. You must include supporting documentation with this form when you submit this offer. Again, this form is only used if you are submitting an offer in compromise with the IRS. You may also, at this point, check out the OIC frequently asked questions on www.irs.gov. Just search the term OIC on www.irs.gov to find these FAQs. And finally, just because you calculate a certain amount to offer based on your 433A OIC, it doesn't mean that amount must be accepted by the IRS. Thanks for watching.
How to complete Form 433B OIC.
The instructions in this video are up to date. However, your form may look different from the images shown. Please visit irs.gov/OIC for the current form and more information.
In this video, we're going to be going over Form 433B OIC, which is a collection information statement for business. You'll need to complete Form 433B if your OIC is for a business entity, such as a corporation, partnership, or LLC. The form should be completed as accurately as possible. Before you start completing this form, just know that if your business is currently in a bankruptcy proceeding, it's not eligible to make an offer. If your business has employees, you must be in compliance with federal tax deposits for the 2 quarters prior to offer submission and the quarter of offer submission, or you are not eligible. This might save you some time beforehand. Basic business information. We're going to go through this form section by section, starting with Section 1. This section is asking for business information. It is very basic. Everything is self-explanatory for the most part, but let's go over a few of the not-so-obvious questions. First off, we have the frequency of tax deposits question. This just refers to deposit for payroll taxes if the business has employees. The IRS requires that businesses use the Electronic Federal Tax Payment System, EFTPS, to make employment tax deposits. You can go into your EFTPS account and view your payment history, find the frequency. Or if you use a third-party payroll provider, you should have the information. The percent ownership and annual salary question is where you'll be telling the IRS who the owners are and how much they're paid. Business sense information and calculate values. Section 2 is business asset information. To meet the section of the form, you'll need to gather the business's most current statements from banks, lenders on loans, mortgages including second mortgages, monthly payments, loan balances, and accountant's depreciation schedules if applicable. Also, include make, model, year, eligibles, and current market value of business assets. To state the current market value, you may consult online auto valuation resources. Also, you can check local real estate postings of similar properties and any other websites or publications that show what the business assets would be worth if you were to sell them. The asset values are subject to adjustment by IRS. If you need additional space, please include attachments and remember to round to the nearest dollar. Remember, if any line item is a negative number, 0. Another quick tip is that if you don't have assets in a certain category, let's say you don't have any real business property as you lease your space, put in /A or none in the appropriate subsection. You don't want it to appear as you've skipped a question. Information that you populate into the section allows the IRS to see what the business has for assets, cash, investments, or machinery. Whatever has some type of value. The key here is sale value, not the highest price you can sell it for. These tools are not worth as much as new ones, and a vehicle that has mechanical problems or cosmetic issues is worth substantially less than one that is in good condition or prepped for retail sale. Basically, you're going to determine what the business is worth if you went out today to try to get money for them ASAP. Be sure to disclose any ownership interest you have in any business. Many times, taxpayers fail to do this. The IRS finds out this information when investigating the offer. Cash investment. Now, let's go through each part of the business asset info section. First up is cash and investments. The cash section goes over basic bank account information to see what cash is in your business bank accounts. For the investments subsection, most companies aren't going to own or bonds, but fill out this section if the business does. So, to find the quick sale value, you'll take the asset's current market value and multiply that by 8, and then subtract the loan balance if there is one. You'll see this equation. Just think of it as the calculation to determine the quick sale value of the asset. Notes and receivables. All right, now it's notes and accounts receivables. These are simple yes/no questions. The difference between notes receivable and accounts receivable is that notes receivable are written promises from third parties agreeing to pay you money in the future. And accounts receivable are payments coming into the business from customers for regular purchases. The answer for many businesses will be no. However, if you do have notes receivable, you'll need to attach a list of these to the offer. You don't have to attach a list of accounts receivable if you have them when you're submitting the offer, but the IRS may ask for them later. Real estate. Moving on, we come to real estate. If a business owns real estate, you'll determine the current market value of it and put it here. As we pointed out earlier in the video, you can use online real estate websites to determine the current market value. Also, be sure to take into consideration the condition of the property to determine the current market value. Business vehicles. Same logic with determining the current market value of business vehicles as with real estate. You want to do a comparison on online auto valuation websites to determine the vehicle's values. You'll want to use private party values and not trade-in values. Some self-employed taxpayers making offers will list their vehicles for the business and personal use on both Form 433A and B OIC, which is not correct. So don't make that mistake. You should list vehicles that are owned by the business on Form 433B and vehicles that are owned by you personally on Form 433A OIC. Of business equipment. The final subsection in the business assets section is other business equipment. Here, you'll list all the equipment or tools used in the business. Say, for example, the business is a bakery. You list all the pots, pans, mixers, ovens, display cases, etc. And again, you're going to go online or to publications that have more items to assist you in determining current market values. Remember to take into consideration the condition of the business equipment. We're trying to determine the quick sale value here. Equity of all business assets to perform. We're at the end of section 2. You're going to add all values of your business assets just determined into this amount box A. This box is the amount available equity in the business's assets. You just simply add the amounts from the lines in the section without a letter beside them. Add lines 1. Cash. 2. Investments. 3. Real estate. 4. Business vehicles. 5. Other business equipment. And place the amount in box A. Income information. Next up, business income information. In this section, you're telling the IRS how much gross income the business generates on a monthly basis. This is basically your profit and loss statement. If you already have a recent 6 to 12 month P&L statement, you can put the monthly amount into box B and skip lines 6 through 10. If you don't have a P&L statement, to enter the average gross monthly income of the business. To determine the gross monthly income, use the most recent 6 to 12 months documenting of commissions, gross receipts from sales, services, etc. Most recent 6 to 12 months earning statements, etc. From every other source of income, such as rental income, interest and dividends, or subsidies. You should enter current income and expense information. For example, if you file an OIC in September 2021, you should include 2021 income expense information rather than only using 20 information. Your entire income should also include income that is considered as non-taxable and may not be included on a tax return. And the IRS may ask for an update of this information later. Business expense information. Now let's go to business expense information, section 4. This is where you determine the total average monthly expenses for your business in box C. This total will then be deducted from box B, total business income, to find the net monthly profit of your business. Having a profit and loss statement is advantageous for completing this section. Enter figures as if they were monthly amounts, just like section 3. With the enough statement, you're going to go straight to box C with the total expenses to a monthly number. You can skip line 11 through 20. Without P&L statement, you're going to create the loss section here. Enter the average monthly expenses of your business using your most recent 6 to 12 month statements, bills, receipts, or other documents showing monthly recurring expenses. Put the total of these expenses into box C. Finally, you'll subtract box C, total business expenses, from B, total business income, and enter this amount in box D to get your remaining monthly income. Calculation of minimum offer amount. Section 5. Calculate the minimum offer amount the IRS will accept to sell your business assets in full. Offer calculations, one is based on paying off the amount over a shorter amount of time, 5 or fewer payments within 5 months. The other is paying your offer in 6 to 24 months. The amount of time you take to Pay your offer in full will affect your minimum offer amount. Paying over a short period of time will result in a smaller minimum offer amount. So, going through the two different calculations. 1. If you will pay your offer in 5 or fewer payments within 5 months or less, multiply remaining income, box D, by 12 to get future remaining income, box E. Do not enter a number less than 0. And remember to round the nearest whole dollar. For example, if your remaining monthly income in box D is $5, your future remaining in C would be $6. 2. If your offer in 6 to 24 months, multiply remaining monthly income, box C, by 24, get future remaining income, box F. Do not enter a number than 0, and remember to round to the nearest whole dollar. For example, if your remaining monthly income in box D is $500, your future remaining income in box F would be $12,000. Finally, you'll take the amount from your box A and add that to the amount from either box E or F, depending on how you plan to pay off your offer to determine your offer amount. Remember, your offer can't be 0, and you can't leave the offer amount blank.